Hello all my dear students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So today we are going to start with something which is the most awaited thing for all of us. All those who are giving your exams in May 2025 or in September 2025 or November 25 as the case may be. I don't know as of now when I am recording the batch. So we are going to compile today 9 RTPs of ICAI which are all updated as per the latest Finance Act 2024. So earlier we used to compile around 6 to 7 RTPs. So this time we have improved ourselves and we have added 2 more RTPs, that is 9 RTPs including the latest one of May 2025. Believe me, this RTP compilation is going to be one of the most important video for you all. I am recording this again. First I have recorded in Hindi English. Now I am again recording for my dearest students who wants to learn in full English, especially from South India, in full English. So I request you all to share this video with as many friends of yours as possible. Now this video is going to be one of the most important video. It is going to be one of the most deciding video for you all. I'll be putting the videos in 3 parts. First, the video for compilation of 9 RTPs, then the video for compilation of 9 past papers, and then the video for compilation of 10 MTPs. MTPs I'll be putting slightly later because ICAI has not yet uploaded the MTPs for your exams. Believe me, if you do these 3 videos properly, along with that, the MCQ video which I have already uploaded in full English for you all, the 35 case scenario MCQ, I don't think so any other thing is required after that. No revision videos would be helpful after that. Believe me. These things will completely 100% cover almost all the important concepts that are relevant for your exams. So watch this video as many times as possible and share it with your friends also. So let us start without wasting any further time. The very first RTP May 2021. The first question over here is of non-resident taxation. There is a company by the name called as Lords INC which is engaged in providing some fees for technical services to an Indian company. There is an agreement between both of them and the agreement is approved by central government. Whenever such words are there in the exam, FTS, approved by central government, etc., agreement is there, then definitely the provisions of 115A or 44DA is applicable. 115A is applicable if the foreign company or non-resident does not have a P in India, and 44DA is applicable if the foreign company or non-resident has a permanent establishment in India. According to that, you have to answer the question. Okay. Now, there are 2 parts of this question. Part 1. Part 1 says that examine the taxability. Also find whether the assessee is supposed to file the return if the assessee does not have a permanent establishment. See, so if the foreign company does not have a permanent establishment and if the foreign company is providing some fees for technical services and there is an agreement between both the party and it is approved by central government and there is no permanent establishment, therefore provisions of 115A are applicable. And as per provisions of 115A, this royalty of 3.2 crore will be taxable at 20% tax, 2% surcharge because the income is more than 1 crore for foreign company, surcharge of 2% will apply and 4% cess. Or compare with DTAA rate whichever is lower. Now in this question DTAA rate is not given, so ignore DTAA. We will tax as per 115A only, 20% plus 2% surcharge plus 4% cess. I hope it is clear to all of you. Plus, is the assessee liable to file the income tax return? Before that, is the assessee going to get some deduction of expenses out of it because they have given us expense of 28 lakh rupees here? No, the assessee is not going to get deduction of any expense over here. Next, is the assessee liable to file the income tax return? No need to file the income tax return. Why, sir? Because the provision says that if the assessee earns only FTS income or royalty income and the TDS is deducted as per 115A, then there is no need to file the income tax return. So we are assuming that the TDS is deducted as per 115A, therefore no need to file the income tax return. Yes, if the TDS would have been deducted as per what? As per DTAA. If the DTAA rate would have been lower, 18%, 16%, 15% or 20%, then if the TDS would have been deducted as per DTAA, then the assessee had to file the income tax return. But in this case, the TDS is deducted. It is assumed that we are deducting TDS as per 115A and the assessee only earns this income. Therefore, no need to file the income tax return. This is what part 1 is all about. Part 2. Part 2 says that if the same company has a permanent establishment in India, then what will happen? Then you will compute income normally. You will compute income by making a proper books of accounts and P&L. How will you compute the income? The fees for technical service 3.2 crore, expense of 28 lakhs. You can take the deduction now because the assessee has a permanent establishment in India. 2 crore rupees, another fees for technical service. Then again 21 lakh rupees expense you are incurring. Then Some expenses which are not wholly and exclusively for the Indian branch, that is not allowed under 4040A. So if an expense is not wholly and exclusively incurred for Indian branch, it is not allowed. Further, if the permanent establishment, that is the branch in India, is making some payment to the HO and it is not in the nature of reimbursement, then it is not allowed. If it would have been in the nature of reimbursement, then it would have been allowed. If this payment by PE to HO is in the nature of reimbursement, then this would have been allowed. But because this is not in the nature of reimbursement, it will not be allowed. I hope it is clear to all of you. And last but not least, what are the other requirements? The other requirements are the assessee has to maintain books of accounts, assessee has to follow the income tax return, assessee has to conduct audit, and the tax rate in this case will be the normal tax rate. And what is the normal tax rate to a foreign company? It is 35% tax, 2% surcharge, and 4% cess, 2% surcharge because the income is more than 1 crore rupees. I hope it is clear to all of you. So this is what this question is all about. And in this manner, I am going to explain you each and every question in detail in this particular video in a very, very comprehensive and in a very, very short manner. We are not going to stretch the discussion for hours and hours and hours and hours for one question. All those things we have already done in class. We have already done all these things in our regular batch as well as in our exam oriented batch. But here the objective is to recap them in a very fast manner so that a day before exam you can again see this at least once before the exam, if not twice. Okay, so let us start with the second question. The second question is a very simple question on penalty. There is an LLP who has filed the return, and in the return the LLP has shown the income as 18 lakh rupees. While processing the return, the income was 22 lakhs. Later on, the assessment was done under regular assessment, the income was 35 lakhs. And then income escaping assessment was done under 147. At that time, income was 42 lakhs. Then last but not least, we have to compute the penalty, and we have to assume that it is not a case of misreporting. It means the penalty will be 50% because it is not a case of misreporting. Now, what is the first time that the penalty will be imposed? The penalty will be imposed while doing the regular assessment. For computing the penalty, what is the first thing that we need to compute? Income assessed minus income processed. Income assessed is 35 lakhs. Income processed is 22 lakhs. 35 minus 22 comes to how much? 13 lakh rupees. 13 lakh rupees is your underreported income. Now, will you compute tax on 13 lakh rupees directly? Never ever do that. First compute tax on 35 lakhs, then compute tax on 22 lakhs, and then take the difference between the two. Okay, and then apply 50% penalty on that. Okay, first compute tax on 35, then compute tax on 22, then take the difference of the two, and then apply what? Then apply the 50% penalty. What is the tax rate, sir? Tax rate for LLP is 30% plus 4% cess. Now, what is the second time that penalty will be imposed? When the income is assessed under 147. So income reassessed under 147 is 42 lakhs minus income previously assessed. What is income previously assessed? It is 35 lakhs. So 42 minus 35 comes to how much? 7 lakh rupees. Now this 7 lakh rupees, again will you compute directly tax on 7 lakh? Never ever do that. Compute first tax on 42 lakhs, then compute tax on 35 lakhs, and then take the difference between the two. And whatever the tax comes, whatever the tax on underreported income comes, then on that you apply to 50% penalty. I hope it is clear to all of you. Don't make a mistake of computing tax directly. Now the third question is of Indian company who is following some MAT provisions. So we need to find the book profit and the MAT liability. So the profit as per P&L account is 52 lakh rupees, and they have given us the P&L account. We need to tell which all items will be added back or reduced from the book profit. First of all, the first item is provision for loss of subsidiary. This is added back in MAT, add back. Provision for doubtful debts, add back. Provision for income tax, add back. Next one, be very careful. Provision for gratuity based on actuarial valuation, do not add back. Sir, why sir? It is not added back. What is added back in MAT is provision for unascertained liability. And if an actuary makes an valuation, it is not an unascertained liability. It is an ascertained liability. Therefore, it will not be added back in MAT. But under the normal provision of the income tax law, when you will compute the income, in this question, they have not asked to compute normal tax. They have only asked to compute the book profit and MAT. But under the normal provision, this actuarial valuation would have been added back because there is a specific disallowance under section 40A7 to add back provision for gratuity. Even if it is made by an actuary, we have to add back under normal provision. But under MAT, we will not add back. Next, depreciation you will add back, and other than revaluation you will reduce. Now, depreciation on account of revaluation is 80,000 and total depreciation is 3,08,000. Therefore, what is other than revaluation? Other than revaluation will be 2,28,000. 3,08,000 minus 80,000, 2,28,000 will be other than revaluation. That much depreciation you have to reduce. Next, interest you will not add back because interest, all these things are not added back under the normal provision. Under MAT, it is added back under the normal provision. Penalty, you will not add back. Then SEZ deduction, you will not reduce because on that MAT is applicable. Then share of income from AOP as a member, yes, that you will reduce. Why? Because the AOP has already paid tax at maximum marginal rate, and if the AOP has already paid tax at maximum marginal rate, then the share of income from AOP is exempt in the hands of member under section 86. I hope it is clear to all of you. And last but not least, long-term capital gains also you will not reduce, because on long-term capital gains also you have to pay MAT liability. You have to pay tax on that. Then adjustment number 1 already done. Adjustment number 2, depreciation as per income tax rules. We will not do anything because that is relevant under the normal provision, not under the MAT liability. Then the total loss as per the books of accounts is 32 lakhs, out of which unabsorbed depreciation is 18 lakhs. Therefore, unabsorbed depreciation is 18 lakhs and total is 32. Therefore, 14 lakh is what? 14 lakh is business loss. It is loss as per books of accounts. Therefore, how much is allowed under MAT? It is loss or UVD, whichever is lower. Therefore, 14 lakhs will be allowed to you. 18 lakhs will not be allowed to you. I hope it is clear to all of you. And last but not least, provision for tax includes 65,000 interest payable. It doesn't matter. Even interest payable is disallowed under MAT. Therefore, if it is included in the provision for tax, it is good enough. We don't have to do anything in that. Then you will compute tax on that. What is your book profit? The book profit is 40,08,000. You will compute 15% book profit of the book profit, 15% of the book profit as tax, and 4% as cess or charge will not apply because the total income is up to 1 crore rupees. That will be your MAT liability. Now there is one second part in this particular question which says that would your answer change if Ganga Limited is located in IFSC and derives income solely in the convertible foreign exchange? Yes, if the company is located in IFSC, then the MAT rate will be 9% instead of 15%. Apart from tax rate, no other changes will be there. The computation will remain same only the tax rate will change in this particular case. I hope it is clear to all of you. Next question number 4. It's on charitable trust exit tax. A trust which was set up in 2015 with an object of relief of poor. Later on, in 2017, they changed their object to provide education to the underprivileged, that is to poor people. So it is allowed to change the object from one object to another, it is allowed. But later on, they applied for registration in 2017 and the registration was granted in 2018. Now, this is a very important date for us. The registration was granted in 2018, very important words. Next one, in 2024, they made a mistake. They got merged with an entity which is not entitled for 12AB. So if you do such thing, if you merge with an entity which is not entitled for 12AB, then in that particular case, you will be liable for exit tax. In that case, exit tax will be computed on you. And how exit tax is computed? For that, we need to compute all the value, FMV of all the assets minus FMV of all the liability. And on that, 34.944% tax has to be imposed. So let us compute the FMV of all assets first, and then we will compute the FMV of all liability, and then we will apply the MMR, that is 34.944% tax in case of exit tax. Now, the first land is there. The first asset is land which is there in Surat. So ignore this particular land. Why, sir? Why we should ignore? Why we should not take this in the accredited income? No, this land will not come in the accredited income because this was purchased before the date of registration. Do you remember? Any asset and liability which has been purchased or which has been incurred before the date of registration shall not be taken in the accredited income. Be very careful. That is the reason I told you the date of registration is very important to us in this question. Second land, Baroda land, which is purchased on 21st of November 2018. Yes, this is purchased after the date of registration. Therefore, this has to be considered. Now, what is the value of this? It is stamp duty value on the valuation date. Valuation date means the date on which you merge with another entity. Stamp duty value on valuation date or market value, whichever is higher. Therefore, in this case, the higher value is 105 lakhs. You will take 105 lakhs as your valuation. For quoted share, you will take the average of the share price on this valuation date. So on 1st of April 2024, for quoted share, what is the average? The highest price is 280, the lowest price is 250. Therefore, the average will be 265. 265 into 3000, that will be the value of quoted shares. For preference shares, you will take the market value as per the merchant banker, etc., based on what? On 1st of April 2024. Now, from where I am saying all these things? I am not saying all these things from my mind. All these things are written under the provisions of Rule 17 CB, which talks about valuation in case of exit tax. Okay. Last but not least, the liability is 112 lakhs, out of which certain liabilities will not be part of accredited income. Corpus fund is not part of accredited income, so reduce that. Even provision for tax is not part of accredited income, reduce that. Even reserves and surplus is not part of accredited income, so reduce that. So reduce these three items, you will get what? You will get your liability. Then asset minus liability, you will get your accredited income. On that, apply 34.944%. Sir, how did you get this 34.944%? 30% tax, 12% surcharge, 4% cess. So this is what this first RTP is all about. Now you will say that in the first RTP only 4 questions are there. It's not like that. There were many other questions, but some of the questions have become redundant because it is a 4-year-old RTP. Obviously, in 4 years, lot of amendments have come. Like section 147 has changed 4 times in last 4 years. So the things have become redundant. The ICI will also not consider those questions. Or it might have been covered in some other RTP or in some other MTP or some other past paper. Believe me, not even a single question we have removed out of all the 9 RTPs. Everything is covered. Only those questions which has become redundant in May 2025 or later attempt, only those questions have been removed from here. Otherwise, nothing has been removed. I hope it is clear to all of you. Now let's go on to the next RTP, that is RTP November 2021. The first question in this RTP is a beautiful question, and first thing that I would like to say over here is we are going to solve this question as per AY 2021-22 and PY 2021 accordingly. Otherwise, this question will not make any sense. Okay, so accordingly, we need to understand that this question is for previous year 2021, assessment year 21-22. Now there are two companies over here, X Limited and Y Limited, and let me talk about both of them first of all. X Limited is an Indian company engaged in generation of electricity. It was set up in 2018, and because it was set up in 2018, it is not eligible for 115 BAB. It cannot be eligible under 115 BAB because for 115 BAB your company should be set up from 1st October 2019 to 31st March 2024. Therefore, it is not eligible for 115 BAB. Yes, you can go for 115 BAA. Now, on the date on which the company was set up, they have employed 500 new employees. All of them participate in the recognized provident fund. The payment was made by ECS. Out of the 500 employees, first 150 employees were paid emolument of 18,000. Next 150 employees were paid emolument of 22,000, and another 200 employees were paid emolument of 26,000. Now on 28th of September 2019, the company started claiming depreciation on WDV. Earlier it was claiming depreciation on SLM. We all know that if you are engaged in generation of electricity, you are eligible to go for either SLM option or WDV option. But from 2019 onward, the company has converted from SLM to WDV. I hope it is clear to all of you. Then the turnover of 1819 and 1920 was respectively 402 crore and 249 crore. Then on 1st October 2020, the company installed new plant and machinery and put to use the same immediately. The company has received dividend of 60 lakhs in the previous year 2021, and the company also paid dividend of 72 lakhs in the financial year 2021 in July 2021. Now let's talk about the second company. Second company is Y Limited. Y Limited is an Indian company. This is set up on 1st of October 2020, and it is engaged in business of printing of books. Be very careful. If you are engaged in printing of books, you are not eligible for 115 BAB. Again, you have to follow 115 BAA only. The date is not an issue over here. The company is set up on the proper time because it is set up between 1st of October 2019 to 31st March 2024. But the problem is with the nature of business. Do you know that there are certain businesses which are excluded from 115 BAB? One amongst them is printing books. If you are engaged in the business of printing of books, you are not eligible for 115 BAB. Now you have also purchased some plant and machinery for 2 crore rupees, and then you have put to use the same on the same day. Then you have also employed 200 employees whose emolument is 25,000 rupees. You paid them by account paycheck. All of them participate in the recognized provident fund. Now the question says that the gross total income as per the special provision, not as per the normal provision. Special provision means 115 BAA BAB. As per the special provision, the gross total income is given as 6.6 crore for X and 1 crore for Y. So they have directly computed the gross total income for us and they have given us. Now we all know that the first company will claim 115 BAA. BAB is not possible. BAB is not possible because of the date of setup. The second company also, BAB is not possible because of the nature of business. So both of them will compute as per 115 BAA only, not as per 115 BAB. I hope it is clear to all of you. Now let's see what the question has asked. Part 1. We have to compute the tax liability of X and Y. Assuming that if they desire to avail the beneficial tax rate, it means they have to follow the special provisions, that is 115 BAA BAB, and which is relevant over in this question, 115 BAA. So we need to compute the tax liability as per 115 BAA for X and Y. Let's compute for X first. For X, the gross total income is 6 crore 60 lakhs. Now, will X be eligible for 80JJAA? The answer is yes. Why? Because the company was set up in 2018 and this is the third year of business. So 80JJAA is allowed up to 3 years. 18, 19, 19, 20, 2021. This year is 2021. We are computing for PY 2021, AY 21-22. Therefore, this year is third year of business. You are eligible for 80JJAA. Now, 80JJAA is eligible for whom? It is not eligible for employees whose emolument is more than 25,000. Therefore, the employee with emolument of 26,000 will not be eligible. Yes, rest of the two category of employees will be eligible. The employees employees with 18,000 emolument, 150 employees, and 22,000 emolument, 150 employees, they will be eligible for 80 JJAA. So let me compute 80 JJAA for these two category of employees. 18,000 into 12 into 150, 22,000 into 12 into 150 into 30%. This is my 80 JJAA deduction. Apart from that, I will also get 80 M deduction under 115BAA. In 115BAA, I get 80 JJAA. I don't get generally any chapter 60 deduction, but I get 80 JJAA, I get 80 M also, and I get 80 LA also. These are the three deductions which are allowed under 115BAA. Therefore, 80 M is also allowed. What is 80 M? 80 M is dividend income earned compared with dividend distributed up 1 month prior to the due date of filing of return. So how much dividend income you have earned? See on the board, the dividend income earned by you is 60 lakhs. And how much dividend you have distributed 1 month prior to the due date of filing of return? It is 72 lakhs. Therefore, whichever is lower will be allowed as deduction. Therefore, 60 lakhs will be allowed as deduction. 3 crore 84 lakhs will be your total income. On that, you will apply 22% tax as per 115BAA, 10% surcharge always under 115BAA, and 4% cess. This will be your total income and total tax. 96,64,510 after rounding off. Now, for Y Limited, the gross total income is 1 crore rupees, as you can see over here. Will Y Limited also get 80 JJAA? No. Why, sir? Because Y Limited is set up on 1st October 2020, and we are computing for 2020-21 only. Current year computation we are doing, and because it is set up on 1st October 2020, the employees are employed for less than 240 days. Because the employees are employed for less than 240 days, they are not eligible for what? They are not eligible for 80 JJAA, and 80 M is not there only in case of Y. Sir, will we get additional depreciation in this? No. Additional depreciation is not allowed under special regime. It is only allowed under the normal provisions of the income tax law. It is not allowed under the special provisions of the income tax law. That's the reason we are not taking the additional depreciation. So for Y, it is very simple. 1 crore into 22% tax plus 10% surcharge plus 4% cess. That's it. That's the computation of Y. Let's talk about second part. Compute total income of X and Y under the regular provisions of the Act. How the things will change under the regular provision? Only one extra thing will come, that is additional depreciation. X has purchased a new plant and machinery of how much? 9 crore, and it is put to use on 1st October, because therefore it is put to use for more than 180 days. Similarly, Y has purchased plant and machinery of 2 crore, and it is put to use for again more than 180 days, because it is put to use on 1st October 2020. So both of them will get 20% additional depreciation. Apart from that, everything is same. Okay. So what is going to change now for X and Y both? For both of them, additional depreciation will come. For X, it is 9 crore into 20%, that is 1.8 crore. For Y, it is 2 crore into 20%, that is 40 lakhs. That's it. Rest of the things are same only. Therefore, X total income will come to 2 crore 4 lakhs, and Y total income will come to how much? Y total income will come to 60 lakh rupees. I hope it is clear to all of you. Let's go ahead with the third part. What is the third part? The third part talks about only X. It doesn't talk about Y. It said, would it be beneficial for X to go for special provision instead of what inserted by Finance Act 2019? For this purpose, you may assume that the book profit of X as per 115JB is 4.2 crore. See, X has two options. Either X can go for special provision or normal provision. If X goes for special provision under 115BAA, then X is not liable for MAT, because if you follow special provision under 115BAA, then the provisions of MAT are not applicable. But if X goes for what? If X goes for the normal provision, then X has to compute two tax. One tax as per the regular provision, one tax as per the MAT liability, and whichever is more beneficial, whichever is higher, he has to pay tax as per that. So if X goes for special provision, that tax we already have. How much is the tax as per special provision of X? As per special provision of X, the tax is already 96 lakhs. Now, if X does not follow special provision but follow the regular provision, how much is the total income of X? Total income of X is 2 crore 4 lakhs. So total income of 2 crore 4 lakhs into 30% tax. Why 30% tax? Because the turnover of last to last year is more than 400 crore rupees. You can check it over here. It is given in the question that the turnover of last to last year is 402 crore. Therefore, the tax liability will be how much? The tax liability in this case will be 30%. 30% tax, because the income is more than what? 1 crore, 7% surcharge, 4% cess. Therefore, the tax as per the normal provision will come to 68 lakhs. Now, what is the tax as per book profit? 4.2 crore into 15% tax plus 7% surcharge plus 4% cess. This is the tax as per the book profit. Therefore, whichever is higher will come to this, and 2 lakh rupees will become your MAT credit, because MAT is more, normal provision is less. Therefore, 2 lakhs will become MAT credit. Now, the question is which you should go for. Obviously, you should go for this, because if you go for this, you are going to pay 70 lakh tax plus you will also get 2 lakh rupees MAT credit also, which you can use in future. But if you go with 115BAA, 115BAA, you have to outrightly pay 96 lakh rupees tax. What sense does it make to go for 115BAA? Don't go for 115BAA, go for the normal provision. I hope it is clear to all of you. Let's go ahead with the next question. Question number 2. We need to explain the tax consequence in the case of the following charitable trust. Each case is independent. In the first cases, there is a charitable trust with a main object of any other object of general public utility. Now we all know that if a charitable trust is registered with main object of general public utility, then it is eligible for exemption only if the commercial receipt is up to 20% of total receipts. If the commercial receipt exceeds 20% of total receipts, it is not eligible for exemption. Now in this case, the commercial receipts of the trust is 44 lakhs. You can check it over here, and the total receipt is 2 crore rupees. Therefore 44 lakhs divided by 2 crore is coming to 22%. Now because it exceeds 20% of total receipts, therefore it is not eligible for exemption under section 11 and 12 in this particular financial year. I hope it is clear to all of you. Let us move ahead with the second question. There is a trust which is paying an annual rent of 12 lakhs in 24-25 and 15 lakhs in 25-26. Now we all know that if a trust pays any expense, then if it wants a deduction of that, it is allowed only if TDS is deducted on that. If TDS is not deducted, then the expense will not be allowed. Now the trust has made a mistake. For 24-25 and 25-26, the trust has deducted the TDS in the current year properly, but it has paid in the next year. Therefore, for 24-25, because it is not paying in the current year up to the due date of filing of return, it is paying in Jan 26 together for 24-25 also and for 25-26 also. Therefore, for 24-25, it is late. It is late. Therefore, 30% of the expense of 24-25 will be disallowed in the current year, and it will be allowed in the year of payment, that is in 25-26. I hope it is clear to all of you. Yes, as far as 25-26 rent is considered, that is fine, because that is paid in 25-26 also, 25-26 only, so there is no issue in that. The issue is with the rent of 24-25. The rent of 24-25 is not paid on time. It is paid after the due date of filing of return of 24-25. Therefore, 30% will be disallowed in the current year, and it will be allowed in the subsequent year. I hope it is clear to all of you. And the third question over here is, a trust was there which is registered under 12AB. Now later on what? They have changed their object. Now we all know that they have changed their object to any other object of general public utility. Initially they were registered as relief of poor. So you can change the object. There is nothing wrong in changing the object. You can change the object, but whenever you change the object, you have to give a fresh application. If you don't give a fresh application, you are deemed to be exited from the trust provisions, and therefore exit tax provisions will apply on you. In this case, you have to make a fresh application within 30 days from the date of change. So if you don't make an application within 30 days from the date of change, from the 31st day, you will be liable for what? Exit tax under income tax law 115 TD 34.944%. I hope it is clear to all of you. Now the third question is a very, very beautiful case law which we have done in the class of Sunil Vishwa Ambarnath Tiwari 2060 Bombay High Court judgment in the chapter of profit link deduction. There is an assessee who was engaged in housing project, and therefore it is eligible for deduction under 80 IBA. Now there are certain expenses on which the assessee has not deducted TDS. Therefore the AO has disallowed that expense. The expense was what? 60 lakh rupees, and the TDS was not deducted. Therefore 30% was disallowed by the assessing officer. 30% of 60 lakhs comes to how much? 30% of 60 lakhs comes to 18 lakh rupees. Therefore 18 lakh rupees is disallowed by the assessing officer. Now the question is whether this 18 lakh rupees which is disallowed by the assessing officer, is that also eligible for 80 IBA deduction? Now the AO is increasing the income by 18 lakh rupees. So whether that increased income will also be eligible for 80 IBA deduction? And the Bombay High Court said yes, that is also eligible for what? 80 IBA deduction. So this is a good news given by Bombay High Court to the assessees. I hope it is clear to all of you. The next question is on beautiful chapter transfer pricing. Very important. Let me give you the scenario. First of all, what is happening in this question? Allianz is a foreign company situated in Switzerland. Delta Limited is an Indian company. Now Allianz is giving a loan of 350 crore euros to what? To us, to Indian company, and we are paying interest of how much? 9%. Now if I convert this loan into Indian rupees, 350 crore into rupees is 88, 1 euro is 88 rupees, so it comes to 30,800 crore rupees loan. Now, so Allianz is giving us how much loan? 30,800 crore loan Allianz is giving us. And what is the book value of our asset? The book value of our asset as per the question is 60,000 crore. So if I divide the loan divided by book value of asset, it comes to more than 51%. So remember, if one entity finances at least 51% of the book value of the assets of the another entity, then both of them are deemed to be associated enterprise. So you have to write down this first in the part 1. Examine whether transfer pricing provisions will apply under this. So you have to write down this. Yes, both of them are deemed to be associated. Therefore, transfer pricing provisions are applicable. It is an international transaction. I hope it is clear to all of you. Now, second part, we need to now check he is giving us loan at what rate? He is giving us loan at 9%, but to others he is giving loan at what rate? He is giving loan at just 7%. Therefore, he is charging 2% extra. Therefore, that much extra we are paying him. Therefore, that much primary adjustment has to be made. Now, how to compute the primary adjustment? 30,800 crore is the loan, and how much extra we are giving him? 2%. So 2% of 30,800 will come to 616 crore. So 616 crore will be added back to my income. I hope it is clear to all of you. That much will be the transfer pricing adjustment that the SSC has to do. Third part says that elaborate on secondary adjustment if required to be made under the provisions of the Act, assuming that Delta has made the primary adjustment suo motu. Assuming that Delta has made the primary adjustment suo motu, elaborate on secondary adjustment. Now it is very clear. If Delta has suo motu made a primary adjustment, then Delta has to bring back that money to India within 90 days from the due date of filing of return. If it does not bring back that money in India within 90 days from the due date of filing of return, he has to pay the interest on the secondary adjustment. Now, how to compute the interest rate? Interest rate will be computed as per LIBOR plus 3%, because the transaction is denominated in foreign currency. Therefore, you will not take SBI's MCLR, you will take LIBOR in this case. LIBOR plus 3% in this particular case. Okay, they have not given us any rate, so we have to just write theoretically. We don't have to compute anything. Plus interest will be computed including the 90 days period. Interest will be computed from 30th November till 31st March. Okay, I hope it is clear to all of you. Now, last but not least, any additional tax assessee can pay and relieve himself in lieu of making the secondary adjustment? Yes, assessee can pay 20.9664% of additional tax of 616 crore, and then the assessee will not be liable for any secondary adjustment. So till the time the assessee does not pay this additional tax, the assessee has to pay the secondary adjustment interest. But once the assessee has paid this additional tax, then secondary adjustment will stop after that. I hope it is clear to all of you. Next question. Let's go ahead with the next question. Which is on non-resident taxation. Analyze the tax consequence. There is a non-resident, Mr. Hugh Grant, who is providing some technical services to an Indian company, and there is an agreement between both of them, and the agreement is approved by central government, and the foreign company does not have any place of business or profession in India. So it is a classic case of 115A. If a non-resident who provides technical services and to Indian company, and there is agreement which is approved by central government, and the non-resident does not have a PE, therefore the provisions of 115A will apply over here. And as per 115A, what is the tax rate? It is the tax rate as per 115A, 20% plus surcharge if applicable, plus cess, or DTAA, which is without surcharge and cess, whichever is lower. Now, in first case, what is happening? Let's see. Pay attention. India has no DTAA with country X. If India does not have a DTAA with country X, then how much tax that Mr. X will pay? Mr. X will pay, Mr. Hughes will pay 20% tax plus surcharge if applicable, if the income crosses the surcharge limit, plus cess. As per 115A, no deduction of any expense will be allowed. Yes, is the assessee liable to file the income tax return? It is very clearly written in the question that wherever TDS is applicable, it has been fully deducted, and the assessee only earns the technical service. Assessee does not earn any other income. Therefore, in this particular case, TDS is properly deducted, and the assessee only earns the fees for FTS income, no other income. Therefore, and the TDS is also deducted as per 115A. See, when the relaxation from ROI is there, when the relaxation from return of income is there, the relaxation from return of income is there in those cases where the non-resident has paid tax as per 115A, then there is no need to file the income tax return. But if the non-resident is paid tax as per DTAA, then they have to file the return. So in part 1, the non-resident is paying tax as per 115A, therefore there is no need to file the income tax return, because the assessee only earns this income and the TDS is also deducted. Now, second case, India has a DTAA with country X and FTS is taxable as 8%. If FTS is taxable at 8%, then the tax will be as per 8%. Then the assessee will get the benefit of DTAA. Okay, no surcharge will apply, no cess will apply, because in DTAA rate, no surcharge and cess further is loaded on that. Flat rate is applicable in case of DTAA. But to take this advantage, assessee has to prove that he is a resident of country X. For that, he has to provide TRC and many other relevant information and documents. Only that he will get the advantage of this particular section. But is the assessee liable for ROI in this case? Absolutely yes, because the TDS is not deducted as per 115A now. It is deducted as per DTAA, and therefore if the TDS is deducted as per DTAA, you have to file the ROI. In the third case, India has a DTAA with country X and FTS is taxable at 20%. So now 25%, sorry. So now in this case, the tax rate will be 20%, because now the DTAA rate is higher, the income tax rate is lower. So the tax will be 20% plus surcharge, plus cess, surcharge if applicable, and cess, and the assessee has to pay taxes for that. Is the assessee liable to file the income tax return? No need to file the income tax return. Why? Because the tax is deducted as per the rates mentioned in 115A and not as per DTAA. So if the tax is deducted as per 115A, no need to file the income tax return. I hope it is clear to all of you. Last but not least, they are asking, will your answer change if the assessee has fixed place of profession in India? If the assessee has fixed place of profession in India, then definitely the answer will change. Provisions of 115 will not apply. Then 44 DA will apply, and according to that, the assessee will make proper P&L, will claim deduction of all expenses, but certain expenses are not allowed, like an expense which is not wholly and exclusively for Indian branch, not allowed. An expense where the PE in India makes payment to HO and which is not in the nature of reimbursement, then it is not allowed. If it is in the nature of reimbursement, it is allowed. Then other requirements which the assessee has to follow: they have to maintain books of account, they have to conduct audit, they have to file income tax return, and the tax rates will also be normal in this case. So this is what this RTP is all about. Now let's go ahead with the next RTP, that is RTP May 2022. The very first question over here is on chapter of capital gains slum sale. There is a company by the name called as Beta Limited, and it is transferring one of its units, Omega unit or unit Omega, to some other company for 600 crores. Okay, 600 crores or 600 lakhs as the case may be. Now we need to compute the slum sale capital gains. First of all, I would like to say one thing, that in case of slum sale, the slum sale still becomes long term after 36 months only. Generally, the Finance Act 2024 has made an amendment that all long term capital gains, all long term capital assets will become long term after 24 months. But under slum sale, they have not made the amendment yet. Slum sale will become long term after 36 months only. Be careful with that. Okay, I have written that in the note also. Now the first thing we need to do, we need to make the calculation. How will we make the calculation? Full value of consideration minus expenses on transfer minus your cost of acquisition. Now what is the cost of acquisition over here? How to compute cost of acquisition? First we will try to understand how to compute cost of acquisition, and then we will see how to compute the full value of consideration. Cost of acquisition in case of slum sale is nothing but net worth of the undertaking which is transferred. Now how to compute the net worth of the undertaking? It is all assets of the undertaking transferred minus all liabilities of the undertaking transferred. How to value the assets? Let's see. First of all, there are fixed assets. In fixed asset there is land and other machineries. For land we have to take the book value. For now we are first computing the cost of acquisition, then we will compute the full value of consideration. Be very careful. So for land we have to take the book value as per the cost of acquisition definition. For machinery, which is a depreciable asset, for depreciable asset we have to take the WDV as per the income tax law. Therefore we will be taking 155 lakhs for the purpose of computing the net worth, that is the cost of acquisition. For other assets, that is debtors, for debtors you are going to take the book value, that is 400 lakhs. For creditors you are going to take 45 lakhs, that is the book value only. You will get the cost of acquisition. Once cost of acquisition is done, the next step would be to find out the full value of consideration. In full value of consideration, we have to follow the rule 11 UAE, which says that you have to compute two FMV, FMV1 and FMV2, whichever is higher, that will be considered to be full value of consideration. So what is FMV1? FMV1 is the FMV of the assets transferred by unit Omega. So whatever assets are transferred by unit Omega, we have to take the asset, the valuation of that asset. And what is FMV2? FMV2 means whatever consideration we have received, we would have received monetary consideration or non-monetary consideration. Whatever consideration we have received, that will be FMV2. Now, how to compute FMV1? Again, I am saying FMV1 means the assets which we have transferred. So what have we transferred? We have transferred first of all fixed assets. What all fixed assets are there? First, land is there. For land, what will you take? Now, for the purpose of computing FMV1, for land, you will take the value as what? Value as stamp duty value and not the book value. Okay. Now for net worth, we were taking the value of land as book value. But for the purpose of FMV1, the value of land will be the stamp duty value of the land and not the book value. Similarly, for machinery, for net worth, we were taking what? We were taking the WDV as per income tax. But for the FMV1, we have to take the book value of the machinery, that is 230 lakhs. And for debtors also, we will take book value. For liabilities also, we will take book value 45 lakhs. After doing all those things, you will get FMV1. Now, FMV2 is very simple. Whatever you have received. What you have received in this slum sale, you have received 600 lakhs in this particular slum sale. That will be your FMV2. Now, compare FMV1 and FMV2, whichever is higher, that will be your what? That will be your capital gains. That will be your full value of consideration. Then reduce from that what? Reduce from that the cost of acquisition, which we have already computed earlier. That will give you a long-term capital gains. So this is a long-term or short-term capital gains. This is a long-term capital gains because the unit was set up in 2010 and it is getting transferred in 2024-25. Therefore, it is getting transferred after 36 months. Therefore, it is a long-term capital gains. We are only computing capital gains. We are not computing tax because the question has not asked us to compute tax. The question said that you have to compute only the capital gains. I hope it is clear to all of you. So let's move on to the next question. Question number 2, which is a total income question. This company was set up on 15th of December 2022. It is engaged in manufacturing and sale of certain items and it commenced the business in Jan 2023. Now always whenever there is a total income question, always read the last line first, what exactly they want from us. They want total income, they want tax liability as per 115 BAB. So according to that, you need to answer the entire question. Now 115 BAB is relevant over here. Okay. Now the very first adjustment over here is they have given us the profit of 220 lakhs. Write down that, and then they have said that it is after debiting and crediting the following following items. Notice what is the first item they have debited? One-time license fees of 22 lakhs paid to APC company. Now license fee is not an expense, therefore you have to disallow that. License fee is nothing but an intangible asset, therefore you will take 25% depreciation on that. You will take full 25% because the asset is put to use on 1st of June. If it would have been put to use for less than 180 days, you would have taken 12.5%. I hope it is clear to all of you. Now next 32,000 you have paid cash to a road transporter, goods transporter. So can you pay cash of 32,000 to a good transporter? The answer is yes. Generally you cannot pay cash of more than 10,000 to a person. But to goods transporter, the limit is 35,000. Therefore, you can pay 35,000 in cash. Now, the third adjustment is the most important adjustment of this particular question. You have earned some rent of 60,000 rupees per month from letting out of an office premise, and you have also paid municipal tax of 8,000 rupees. Now, pay attention, please, all of you. Whatever rent you have paid, 60,000 into 12, that is 7,20,000 rupees. First of all, you will reduce that from PGBP and you will show that rent as income from house property under income from house property heads of income. Okay. First of all, we will do this. Second, 8,000 rupees house property municipal tax which you are debiting to PNL, you will add back that. You will add back that to PGBP. But when you go to 115 BAB, you cannot claim the deduction of that because remember, in 115 BAB, you don't get deduction of any expense against general income. Like house property is a general income, like dividend is a general income. Against that, you don't get any deduction of expense. Therefore, this deduction will not be allowed. Even 30% standard deduction won't be allowed to you under 115 BAB. Therefore, under 115 BAB, entire 7,20,000 rupees will be directly taxable in your hands under the income tax law at 22%. Okay. I hope it is clear to all of you. Next one, you are making some payment of 2 lakh rupees for Scientific Research Association as a donation. That is not allowed under 115 BAB. Similarly, 5 lakh rupees you have paid as a payment to contractor, but you have not deducted the TDS. Therefore, 30% of the 5 lakh will be what? Will be disallowed under the income tax law. Next one is also a good adjustment. 10,000 you have earned as a dividend from Gamma Limited. So this dividend of 10,000 you will reduce from PGBP and you will show under what? Under income from other source. Apart from that, you have also sold some shares. How many shares you have sold? You have sold 1,000 shares of rupees 100 each. You have purchased at 100 in 2017, but you sold for what? You sold for 280 rupees. Now, whatever is the profit as per books of accounts, whatever is the profit as per books of accounts, you have credited that to the books of accounts. So first of all, you have to reduce that profit from the PGBP. The sale price is 280. The cost of acquisition of the share is 100 into 1,000 share. Whatever profit is come, that is your accounting profit that you have to reduce from the books of accounts, and you have to show under long-term capital gains because you have purchased in 2017 and you are selling in 2025. Therefore, you have to show that as a long-term capital gains. Now, which long-term capital gains it is? It is a long-term capital gains covered under 112A. Why, sir? Because in the additional information they have given us, see the fair market value on 31st Jan 2018. Whenever this is given, it means it is a long-term capital gains covered under 112A. Therefore, now you will compute the long-term capital gains under 112A as per the grandfathering clause. What is your sale consideration? The sale consideration of the shares is 280 rupees. How will you determine the cost of acquisition? For that, you will apply the grandfathering clause because the shares were acquired before 1st Feb 2018 and the institute has also given us the information of FMV on 31st Jan 2018. Now, how to compute the cost of acquisition? Cost of acquisition, step number 1, actual cost. Actual cost is 100 rupees. Step number 2 is lower of sale consideration, that is 280 rupees or FMV on 31st Jan 2018, that is 110, whichever is lower, that will be compared with your actual cost, step number 1, and then whichever is higher, that will become your cost of acquisition. And then whatever amount will come, that will become your long-term capital gains. From that, 1,25,000 will be exempt and 12.5% will be the tax rate because these shares are sold on or after 23rd July 2024. 1,25,000 exempt, 12.5% will be the tax rate. I hope it is clear to all of you. Now, next adjustment is on next page, that is in this page only. Depreciation as per books of accounts is 2.2 lakhs. Therefore, that will be added back because that is accounting depreciation. Depreciation as per tax is 2.6 lakhs. That will be reduced because that is as per the income tax law. Apart from that, you have also purchased some machinery of 20 lakh rupees on 15th of November and it is put to use on the same date. This depreciation is not included in 2.6 lakh. So you have to claim depreciation on that, but you will get only normal depreciation. You will not get additional depreciation because the asset is because the asset is following 115 BAB. Plus, you will get only 50% of the normal depreciation because the asset is put to use for less than 180 days. Therefore, you will claim 7.5% only. You will not claim full 15%. I hope it is clear to all of you. And last but not least, the SSC is also eligible for 80 JJAA because they are employing some new employees in the business, and along with 115 BAB, you can follow 80 JJAA. Therefore, 80 JJAA will be allowed to whom? It will not be allowed to whom? First of all, I will tell you that. It will not be allowed to employees with 26,000 emolument. It will not be allowed to employees with 27,000 emolument because the emolument per month has to be up to 25,000 rupees. If it is more than 25,000 rupees, you are not eligible for 80 JJAA. Third, it is not allowed to this last employee also, because that employee is employed on 1st of September, and therefore it will not amount to 240 days in a year. The employee has to be employed for at least 240 days in a year if you want to claim the deduction under 80JJAA. Therefore, the only employee who will be eligible is the first category of employee. 51 employees into 12 months into 23,000 into 30%. That will be the deduction under 80JJAA. That will be eligible. Last but not least, you are going to compute the tax. So on this house property, you can see no deductions are allowed, as I have told you earlier. On this, you will pay 22% tax. On business and profession income, that is your manufacturing business, on this you will pay 15% tax. On long-term capital gains, 1,70,000, 1,25,000 will be exempt, and the balance will be subject to 12.5% tax. And on dividend income, you will be liable for tax of how much? Dividend income will be subject to what? 22% tax, because that is again a general income. This is how you are going to compute the tax, plus 10% surcharge, always under 115 BAB, and 4% cess, always under 115 BAB. I hope it is clear to all of you. Let's move ahead to the next question. Question number 3. What is this question? This question is on computation of MAT liability, but now they have given us what? They have given us other comprehensive income. So this is a question of MAT with Ind AS. Ind AS compliant companies, how will they compute the MAT? So for example, what is the net profit? What is the book profit of the company? The book profit of the company before making the Ind AS adjustments is 97.54. Now they have given us OCI that will now never be classified to the statement of profit and loss account. So something which will never be classified to the statement of profit and loss account, you have to adjust today itself, except few items which have been excluded from the definition. Again, I am saying something which will never be debited or credited to the P&L. You have to debit today, you have to credit today, and you have to add to the book profit. You have reduced from the book profit, except few items which the government has told you not to do it. Okay. Now the very first thing, deferred cost hedging, debit. This will never be classified to P&L. So debit that today, reduce that from the P&L today. Similarly, changes in the fair value of equity instrument. This will never be classified to the P&L, but don't debit this today, because this is an exception to this particular rule, which will never be classified to the P&L. So still you should not debit to P&L. This will be adjusted. This 7.4 lakhs will be adjusted in the year in which this equity instrument will be sold, not on accrual basis, not on fair value basis. Similarly, revaluation of fixed asset. By default, you should add back to the income, but you should ignore this, because this is also in the exception which says that the changes in the fair value of the asset, fixed assets, has to be adjusted in the year in which the assets are sold, not on fair value basis. Last two items are not in the exception. Therefore, these two items has to be added back to determine what? To determine your correct book profit. Apart from that, the assessee also has some losses, some depreciation. Generally, under book profit, you get deduction of lower of business loss or depreciation, whichever is lower. You don't get deduction of both of them. Either you will get deduction of business loss, or you will get deduction of depreciation, whichever is lower. But in this case, the assessee is approaching National Company Law Tribunal for resolution of the business. So in this case, there is an exception that if an assessee is approaching NCLT for resolution of the business, then both of them are allowed. Therefore, this is also allowed. Entire business loss of both the years and entire depreciation of both the years will also be allowed to the assessee. Last but not least, there is some transition amount of 68 lakhs. Generally, whatever is the transition amount, that is added to the book profit in 5 equal years. So you have to divide that by 5 and you have to add back. But certain things are never part of transition amount. Like capital reserve of 8 lakhs. It is never part of transition amount. You can go and check the definition of transition amount. Similarly, 6 lakhs, which is relating to translation difference in foreign operation. This will also never be part of never be part of what? Transition amount. Therefore, these two things you have to reduce. That these two amounts to 14 lakhs. Therefore, 68 lakhs minus 14 lakhs comes to 54 lakhs. Divide by 5. That will give you what? That will give you the answer of divide by 5. That will give you the transition amount that you have to add back to the book profit for next 5 years, including the current year. Then you have to compute the book profit. Book profit is 15% tax. MAT you have to compute, 4% cess you have to apply, and then you compute the provisions of tax as per the normal provision. The normal provision income they have already given us, it is 12.8 crore, and then you have to compute what is the MAT credit. I hope it is clear to all of you. Now next question is on charitable and religious trust. There is one institution who is engaged in educational purpose as well as hospital, which is registered, which is covered under 1023C. Therefore, it wants to claim exemption without registration. Now, they can claim exemption without registration provided the aggregate receipt from both of them is up to 5 crore. If the aggregate receipt from both of them is more than 5 crore, then they cannot claim exemption without registration. Then they have to get themselves approved first. Then only they can claim exemption. Now, in this case, the individual receipt is 3 crore each. Therefore, the aggregate receipt will be 6 crore. Hospital is 3 crore. Education is 3 crore. Aggregate receipt is 6 crore. Therefore, they are not eligible for exemption without registration. They have to get themselves registered. I hope it is clear to all of you. Next question. There is a trust who has made some excess application. Too much application they have made, because of which there is a loss. Now, can they carry forward that loss? Can they carry forward the excess application and set off that against the income of the next year? And the answer is no. That is not allowed to the trust. It is very clearly restricted to the trust. I hope it is clear to all of you. Next one. There is a trust who has taken a loan of 40 lakhs from SBI for purchase of building. Now, the trust has taken a loan and they have purchased the building also. Whether the trust will get the deduction of the purchase of building as an application? The answer is no. It is not allowed. When you take a loan and with the help of that loan money, if you purchase anything, that is not allowed as an application. However, when you repay that loan, at that time it will be allowed as an application. So out of that, only 5 lakh is repaid, therefore only 5 lakh will be allowed as deduction. That too, there is an amendment which is made by Finance Act 23 that you have to repay within 5 years. If you repay within 5 years, then only it is allowed as deduction. Otherwise, that is also not allowed as deduction. Next question is on section 194O, which is on TDS by e-commerce operator. There is an e-commerce operator by the name called as High Sale, and there is an e-commerce participant, that is a seller, resident seller, by the name called as Appy. How much goods have been sold through that e-commerce operator by Mr. Appy? 84 lakhs of goods are sold by Mr. Appy. But therefore, e-commerce operator will deduct TDS at the rate of 1% till 30th September, and from 1st October the rate has been reduced to 0.1%. But Mr. Appy has done one mistake. The seller has done one mistake. What is the mistake the seller has done? The seller has not given the PAN or Aadhaar. So if he is not giving the PAN or Aadhaar, in that case the return has to be filed at, the TDS has to be deducted at 0.1% or 5%, whichever is higher. Therefore, in this case the TDS will be deducted at 5%. Generally, if the buyer or if the recipient, if the payee does not give PAN, then you have to deduct TDS at 20%. But there are two exceptions where you will not deduct TDS at 20%, but you will deduct TDS only at 5%. One is 194O, this section, and one is 194Q. These two sections, the maximum TDS is 5% if the buyer, if the other person does not give what? If the other person does not give the PAN. So in this case also you will deduct TDS at 5%. Okay. I hope it is clear to all of you. Next question is a beautiful question on what? On non-resident taxation. There is a company by the name called as Trex Limited, which is a company incorporated in country T, and they have earned some incomes. We need to compute the tax and we need to say which incomes are taxable and at what rate it is taxable. First of all, this foreign company has given some services to Indian company in the nature of technical know-how. Indian company, and in return, Indian company has given what? Indian company has not given money. In return, Indian company has given debentures of 30 lakh rupees. So foreign company has given us what? Some technical know-how. We have given them debenture of 30 lakh rupees. Is that taxable? Obviously, yes, taxable. Consideration may be in cash, consideration may be in kind. It doesn't matter. But will this 30 lakhs be taxable as 115A? The answer is no. For 115A, the agreement has to be there between both the company and it has to be approved by central government. There is no presence of agreement between both of them and there is no approval by central government. Therefore, it cannot come under 115A. Therefore, it will be taxed at normal rate. What is the normal rate for a foreign company? It is 35% from Finance Act 2024. Earlier, it was 40%. Okay. Similarly, on this debenture, this foreign company will now earn interest. How much interest they have earned? They have earned interest of 2,85,000. Will this interest come under 115A? Again, it cannot come because this is not a loan given in foreign currency. It is a loan given in Indian currency. Therefore, this will not come under 115A. Otherwise, it would have come under 115A. It would have been taxed at 20%. But this is not a loan given in foreign currency. This is a loan given in Indian currency. Therefore, this will be taxed at what? Therefore, this will also be taxed at 35%. I hope it is clear to all of you. Then some dividend has been earned on GDR. So this will be taxable at 10% under 115AC. Then some dividend on equity shares have been earned on Indian companies. This will be taxable at 20% under 115A. Then some business income I will talk first. Business income of 8,50,000 is taxed, will be taxed at 35%. Then long-term capital gains of 1,32,000 on transfer of unlisted shares. It will be taxed at 12.5%. We are assuming that it is transferred on or after 23rd July. Therefore, it is 12%. If it is transferred before 23rd July, then it will be 10%. Now coming to the most important point, that is point number 4. Some royalty income is earned. Some royalty income is received of 12,56,000 from Z Limited in pursuance of an agreement which is approved by central government. Now, can this come under 115A? The answer is definitely yes. This amount can come under 115A because this is the royalty which is approved by central government and there is an agreement between both of them. So this will come under 115A. This will be taxed at 20% plus surcharge and cess if applicable. Cess always applicable, surcharge depends upon the total income. Now, you need to be very careful. The income of the assessee is not 1256. This is the amount received. Therefore, if this is the amount received, this will be after the TDS. And what will be the TDS in this case? It will be 20% tax plus 4% cess. 20.8% will be the TDS deducted by the Indian company MNO Limited. Therefore, the assessee has to gross up its income because this is not the final income. This is the net income received by the assessee. This is not the final income. This is not the gross income. Therefore, the assessee has to gross up the income. How will it gross up? TDS is 20.8%. Therefore, 12,56,470 will represent 79.2%. Therefore, 100% is how much? Cross multiply and gross up and take the final amount. Okay, it will come around somewhere around 15 lakh rupees. I hope it is clear to all of you. Now, One last question in this RTP, very simple question. We need to compute the total income and tax of the assessee. Assessee is a resident, aged 52 years, and is earning income from India, country G, country M, and some other information is also given. You have to compute the tax as per the old regime. So it's a DTAA question, unilateral relief question, very simple question. So first of all, we will take everything in the Indian income, and then we'll compute the Indian average rate, and then we'll compute the foreign average rate. Okay. Then first of all, income from business in Pune, you will write down this. Then in profit from partnership firm in Mumbai, this is exempt. This will not be subject to tax. Then agriculture income, that will be taxable because foreign agriculture income is taxable. Agriculture income in India is exempt. Then brought forth business loss will be allowed as deduction against the business income in India. You will say it is not allowed in that country. In that country it is not allowed now, but India it is allowed now. So you have to take the deduction in India. Then dividend income you will take. You will multiply by 70 rupees dollar. Rental income you will take. Then municipal tax you will take. In that country it is not allowed, but in India it is definitely allowed. You can claim the deduction. Then you will compute GTI. After that you will take 80C deduction because you are following old regime. So therefore you can take 80C deduction. Then you will claim 80D deduction, but only 25,000 rupees, not 28,000 rupees, because you are not senior citizen. You are just 52 years old. And then you will compute the average rate in India. This is your total income. Total income is above 1 crore. Therefore you will apply surcharge of 15% also because it is between 1 and 2 crore. And then you will apply cess and find the average rate in India. And then you will find the doubly tax income. Okay. Whatever is the doubly tax income, and then you will compare. It's a very simple question on DTAA. Nothing great as such, you can see. Okay. Now let's go ahead with the next RTP November 2022. What they are asking in the first question, they are asking us to compute total income and tax payable by the firm, and the firm has opted for 35AD. 35AD, they have fulfilled all the conditions of 35AD. So it's a question on partnership firm, total income and tax liability, tax payable. So the partnership firm, which is engaged in the business of 3-star hotel, which started the business on 1st of April 2024. There are two partners in this particular question with equal profits, and the profit is 26 lakh rupees after deduction of the following items. So let us compute the tax total income and then tax liability of the firm. First of all, depreciation as per books of accounts will be added back. Then interest on capital of 15%. 15% is not allowed, only 12% is allowed. Therefore 3% you have to add back, make a backward calculation, add 3% back. Then you have taken some loan from Mr. Rajveer, a resident. The firm has taken loan from Rajveer, a resident, and the firm is making the payment of interest of 6 lakh rupees. But unfortunately, they have not deducted the TDS. Therefore, 30% expenditure, that is 30% of 6 lakhs, will be disallowed in this particular case. Okay. Now, after this, first, one thing I would like to say in this question, there is no remuneration paid to the partner. Therefore, you don't have to compute any book profit, something like that. There is nothing to do all those things. Okay. Now, they have purchased some motor car for 7 lakh rupees for the purpose of the hotel. Therefore, this is a capital expenditure. Therefore, that will be eligible for deduction under 35AD. This 7 lakh is fully allowed as deduction under 35AD. Then they have incurred some 2 crore rupees further expense, out of which 1.5 crore is land. So land, goodwill and financial instruments are not allowed under 35AD. Therefore, this will not be allowed as deduction. But 50 lakhs building will be allowed as deduction. Apart from that, they have also installed some AC air conditions on 15th of May 2024 of 3,20,000. So that will also be allowed as deduction. I hope it is clear to all of you. And all the payments are made by account, pay, check or ECS. Therefore, it is allowed. Otherwise, if you make a payment of more than 10,000 to a person in a day, and if you make the payment by other than 4 modes, then it is not allowed as deduction. Therefore, this line is also very important. Now, if I take all this deduction, the firm is getting some loss. Now, if the firm is getting some loss, the question is, can this loss be set off against the profit of another 4-star hotel whose profit is 41,38,000? The answer is yes. A 3580 business loss can set off only against 3580 business. Therefore, the loss of this 3-star hotel can set off against the profit of this 41,38,000 another 4-star hotel, and then that will be your total income. Therefore, the total income in this case comes to 34,78,000. On this, you will apply 30% tax as per partnership firm, 4% cess, and that will be your tax liability. Now, the answer will not complete here, because if a partnership firm is claiming 35AD, then AMT is applicable, alternate minimum tax. Therefore, now I have to compute what? I have to compute alternate minimum tax. For that, I have to compute what? I have to compute adjusted total income. What is adjusted total income? See on the board. It is nothing but total income of 34,78,000 plus all the 35AD deduction. All these 3 deductions will be added back. 50 lakhs will be added back, 7 lakh will be added back, 3,20,000 will be added back. All of them are covered under 35AD. Therefore, you have to add back all those things. But you will claim depreciation on all 3 of them. On building you will claim 10% depreciation, on motor car and on air condition you will claim 15% depreciation. That is something which is allowed to you. After doing this, whatever amount will come, that will be your adjusted total income. It is 88,45,000 rupees. On that you will apply 18.5% tax. 4% cess surcharge will not be applicable because the income is less than 1 crore rupees. And then you will compare both the tax, whichever is higher will be your tax liability. And if your MAT liability is more, then you will also get what? MAT credit, as you can see over here. I hope it is clear to all of you. Let's go ahead to the next question. Question number 2. This is a question on total income. This is an Indian company engaged in manufacturing, and always in case of total income, always read the last line first. The examiner wants us to compute total income and tax liability, that too as per 115BAA. Now if you are following 115BAA, your tax rate is very straightforward. 22% tax, 10% surcharge, 4% cess. Therefore, the turnover of last to last year given to us is of no use. This is relevant only under the normal provision, not under the special provision. Okay, I hope it is clear to all of you. Now coming to the discussion of adjustment by adjustment. Your profit is 9 crore 50 lakh rupees. Your first item is depreciation, so that is the depreciation as per books of accounts, so add back that. Second is donation to political party, not allowed under 115BAA. Third one is scientific research association donation. You are giving some donation to scientific research association, that is also not allowed under 115BAA. Next is you are receiving some dividend from a foreign company. So this dividend will be first reduced from PGBP, and dividend income will be shown under what? It will be shown under IFOS, income from other source. Next, you are earning some long-term capital gain on sale of equity shares on which STT is paid. Therefore, this long-term capital gains is 112A long-term capital gains. Therefore, you will reduce this from PGBP. You will show this under capital gains. On this, 1,25,000 will be exempt and the balance will be subject to 12.5% tax. We are assuming that this long-term capital gains has arisen on and after 23rd July 2024. If it is arise before that, then you will be subject to 10% tax. If it is arise after 23rd July, then you will be subject to 12.5% tax. We are assuming after. That is the reason we are taking 12.5% in the solution. Okay. Now next one is a very important adjustment for us. You have taken some loan for the purchase of machinery. Now what is the amount of loan? It is 4 crore 20 lakh rupees. When have you taken the loan? On 1st of June. Therefore, what will be the total interest of the year? 4 crore 20 lakhs into 10% into 10 months divided by 12 months. Therefore, the total interest will be 35 lakhs. First of all, disallow this entire 35 lakhs. Disallow this entire 35 lakhs. I will disallow this entire 35 lakhs. Now, I have taken this loan for what? For the purpose of machinery. Now, when have I put to use the machinery? You can see on the board, just additional information to sub point 3. I have put the machinery on use from 1st of Jan. Therefore, from June to December, the machinery's interest, the loan's interest has to be capitalized to the machinery. From June to December, how many months are there? 7 months. Therefore, 7 months interest. First of all, what is the first treatment? Entire interest you will disallow first under PGBP. Then 7 month interest you will add to the cost of machinery, and then you will claim depreciation. And 3 months interest you will not take deduction. Why? Because it is unpaid. See, interest is outstanding. If it would have been paid till the due date of filing of return, I would have taken the deduction. So for capitalizing the interest, there is no need to make the payment. No, be very careful. The payment is only required to claim that as a revenue expense. If you want to capitalize the interest, there is no need to make the payment. You can take the deduction of depreciation without even making the payment. I hope it is clear to all of you. Next one, you are selling some plot of land to PQR, an Indian company. The entire shares are held by us. So PQR is a subsidiary we are holding. We are 100% holding. PQR is also our 100% subsidiary, and PQR is Indian company. And because the recipient is Indian company and there is a 100% relationship, this transfer is exempt transfer under section 47. Therefore, reduce from PGBP and exempt under section 47. Show as exempt under section 47. I hope it is clear to all of you. Next one is you are making some payment of 1 crore rupees to foreign technician for installation of machinery. So installation of machinery you will add back under PGBP and you will add to the cost of the machinery. You will claim depreciation on that. I hope it is clear to all of you. Now the next adjustment is a beautiful adjustment. You have sold some goods of 22 lakh rupees credit sales, out of which 12 lakh rupees have become bad debts. Now how much is receivable? 10 lakh is receivable. Now the debtor has died. Now the debtor is died. How much I am supposed to receive from him? 10 lakh, and he is dead. Now somebody on his behalf has paid me 11 lakh rupees and I have credited the entire 11 lakh rupees to the PNL, which is wrong. Why the hell you have credited entire 11 lakh to the PNL? This 10 lakh rupees is already included in the credit sale. You have already paid tax on this 10 lakh rupees. What is extra received by you is only 1 lakh rupees. You should pay tax on 1 lakh rupees. Therefore, entire 11 lakh rupees should not be credited to PNL. Therefore, only 1 lakh rupees should be taxable. Therefore, reduce 10 lakhs from the PGBP income. I hope it is clear to all of you. Then depreciation is 1 crore 50 lakhs to claim depreciation on that. Certain additions are made to the assets. Office building of 3 crore put to use from December, therefore claim 50%. That is, generally building is subject to 10% depreciation. But in this case, because it is put to use for less than 180 days, take 5%. Computer put to use from 11th May, take full 40%. And then on machinery, you will claim what? Normal depreciation. Additional depreciation you are not going to claim because we are following 115BAA. On machinery, how much, what will be the cost of machinery? See, 500 lakhs will be the basic cost of the machinery, plus 24.5 lakh rupees. You have to capitalize the interest from here, plus 100 lakhs you have to capitalize what? You have to capitalize the foreign technician salary for installation of machinery. That will come to 624.5. On that you will claim what? 50% depreciation. So why 50%? Because again the machinery is put to use for less than 180 days. And last but not least, if you are following 115BAA, you are eligible for deduction under ATM because you have distributed dividend of 12 lakh rupees 1 month prior to the due date of filing of return. How much dividend you have earned? You can check it over here. You have earned the dividend of 15 lakh rupees here. And how much dividend you have distributed? You have distributed dividend of 12 lakh. Therefore, whichever is lower, 12 lakh will be allowed as deduction to you. So this is what this question is all about. And the last but not least, tax calculation I have already told you. For 112A, 2,75,000 will be taxable, 1,25,000 will be exempt, and balance will be subject to, out of 4 lakh, 1,25,000 exempt, 2,75,000 will be subject to 12.5% tax, and balance income will be subject to 22% tax. I hope it is clear to all of you. Then for 10% surcharge and 4% cess. Now let's move on to the next question. Question number 3. Mr. Rajesh is a resident unit holder of 2 entities. One is PQR. PQR is an AIF, Alternative Investment Fund, and one is Shipra. Shipra is a REIT, which is Real Estate Investment Trust, that is business trust. Okay. Now let me tell you one thing very clearly. Mr. Rajesh holds 10% units in both Shipra and PQR. Mr. Rajesh holds 10% units. Now whatever income Shipra will give Rajesh and PQR will give Rajesh, that will be taxable in the hands of Rajesh. But one thing you have to be very careful. In case of REIT, only the income which is actually paid, that will be taxable. But in case of PQR, that is AIF, even the income which is not actually paid but it is only accrued in the hands of AIF will also be taxable in the hands of Mr. Rajesh. So point I am trying to say, in case of business trust, income in the hands of unit holder is taxable on receipt basis. But in case of AIF, income in the hands of unit holder is taxable on the basis of accrual system. Okay. I hope it is clear to all of you. And in both the cases, they have distributed only 90%. They have not distributed entire 100%. So this will play some role in the question. Now, one last thing that I would like to say before we start with the question, we have to compute total income and tax payable in this question. Now, whenever they are using the word tax payable, it means you need to compute the tax liability first, and then you need to reduce the TDS and advance tax and TCS credit if it is given in the question. So there is a difference between tax liability and tax payable. When the institute is asking you to compute tax liability, then only compute tax and leave it. But when they are asking tax payable, then you have to find out after TDS, TCS and advance tax credit, whatever amount is balance payable, that you have to compute. So like that, in this question, we have to compute tax payable. Okay, be very careful. Now let's start with the question. First of all, GPL is a SPV in which business trust holds 100% share. So GPL is a SPV. So from SPV, business trust is receiving dividend of 2 crore and the SPV is not opting for 115BAA. Therefore, this dividend will be exempt in the hands of Mr. Rajesh also, who is a unit holder. Because remember, if a business trust receives dividend and pass on to the investor, then it is exempt in the hands of investor if the SPV does not offer 115BAA. If the SPV offer 115BAA, then it is taxable. Therefore, this dividend income is exempt in the hands of Mr. Rajesh. Similarly, dividend after dividend, interest. SPV is giving interest of 3 crore rupees to the business trust. Out of that, how much is paid to the investor? How much is paid to the investor? Only 90% is paid to the investor. Out of which, how much Mr. Rajesh holds? Only 10%. Therefore, 3 crore, 90%, 2.7 crore. Of that 10%, 2.27 lakhs. 27 lakhs will be taxable in the hands of the Mr. Rajesh. I hope it is clear. And on that, REIT will deduct TDS at the rate of 10% because interest from SPV is exempt in the hands of REIT but taxable in the hands of investor. Therefore, and it is taxable on receipt basis, not accrual basis. Therefore, the TDS will also be deducted only on 90% of the income, not on the entire 100%. Third one, on STCG, on sale of properties, the REIT will pay tax. For Rajesh, it is exempt. Now coming to what? Now coming to the second part, that is income from PQR. Business income from AIF. On that, AIF pays tax and it is exempt in the hands of investor. So business income, AIF pays tax, investor don't have to pay any tax. Similarly, long-term capital loss. Long-term capital loss will be carried forward by Mr. Rajesh, that is the investor. Investor will carry forward. Why? Because the unit holders are holding the unit since 2022, and the law says that if the unit holders are holding the units for more than 12 months, then the losses will be given to the investor. In this case, this loss of 27 lakhs will be transferred to the investor. Whenever they will earn long-term capital gains, they will set off this long-term capital loss against that long-term capital gains. Last but not least, interest income from AIF. On that, investor will pay tax. On how much amount? Only 90% is distributed. So investor will pay tax on 90% or entire 100%? Entire 100%. That's what I was trying to say. Here the concept of accrual basis is applicable. Even if the AIF has distributed only 90%, the investor has to pay tax on entire 100%. Therefore, Mr. Rajesh will pay tax on how much? 5,20,000 because he holds 10% stake. And how much TDS will be deducted of Mr. Rajesh? 10% TDS will be deducted of Mr. Rajesh in this case, and in this case also 10% TDS will be deducted. Now we will compute the tax liability of Mr. Rajesh. Mr. Rajesh is following the new regime. You can see in the question. 32,20,000 is the total income. You will apply the new slab rates. 3 to 7, no tax. 3 to 7, 5%. Then 7 to 10, 10%. Then 10 to 12, 15%. Then 12 to 15, 20%. 15 to 32 lakh. Above 15 lakh, it is 30% plus 4% cess. And this is your tax liability. But the question is not asking tax liability. The question is asking tax payable. So for tax payable, you have to reduce the 2 TDS which has been deducted by different entities. 2,70,000 you will deduct first. 52,000 you will deduct first. After that, whatever amount comes, that will become your tax liability, tax payable. I hope it is clear to all of you. Let's move on to the next question. Here we have to comment on whether the TDS or TCS is applicable in this case. Now there is one person by the name called as Mr. Devansh. He is an Indian citizen and he is a resident. He is a non-resident, sorry. He hardly comes to India for a few days every year, okay? So he's a non-resident. Now he's coming to India and he's booking some tour operator. He's booking some tour to Malaysia from Mumbai for 1 week. Now, whether 206C1G will be applicable to him. So remember, 206C1G is applicable if you book a foreign tour, okay? Overseas tour package and program. And up to 7 lakh, 5% TCS is applicable, and above 7 lakh, it is 20%. But remember, CBDT has given a relaxation that if a non-resident comes to India for a visit, then for him, if a non-resident comes to India for a visit, then for him provisions of 206C1G is not applicable. Therefore, in this case, the provisions of 206C1G is not applicable to Mr. Devansh. I hope it is clear to all of you. Now, let's come to the next question. XYZ is incorporated in the current year. So, XYZ is incorporated in 2024-25, and XYZ is a buyer of goods. And White Ride is a seller of goods, and White Ride's last year turnover is 11 crore rupees. Last year turnover is 11 crore. Now, so whether the buyer will deduct TDS or the seller will collect TCS, that we need to answer in this particular question. So in this question, the buyer is not liable to deduct TDS because the buyer has been incorporated in the current year, and therefore the last year's turnover of buyer is 0 rupees. And because the last year turnover of the buyer is 0, therefore buyer is not eligible for 194Q. Therefore, the seller is eligible for 206C1H. Now, when the seller will be liable to collect TCS? In 206C1H, TCS is applicable on receipt basis. Whenever the amount will be received in excess of 50 lakh rupees, at that time seller will collect TCS. So first 25 lakhs, no TCS. Next 30 lakhs, on 5 lakhs, 0.1% TCS will be applicable. The sale has been made on 15th of September, but the question says that the payment is made on the immediate following month. Suppose if you are selling on 15th of September, then the payment is made on 15th of October. That is 1 month after the date of sale. Therefore, TCS will be applicable on receipt basis, not on accrual basis. So, on this case, on 5 lakh rupees, 0.1% TCS will be applicable 1 month after the date of sale. That is on 15th of October. Then on this 15 lakh, 0.1% will be again applicable 1 month after the date of sale. That is on 15th of Jan. I hope it is clear to all of you. So this is what this question is all about. Next one. Mr. Ravi Prakash is a resident. He is 52 years. He has gifted a sum of 30 lakh rupees to his wife on the occasion of her birthday. We need to answer whether his wife, Mrs. Sudha, is liable to file the income tax return. Now, what is the income of Mrs. Sudha? Mrs. Sudha only has rental income of 25,000 rupees per month, which amounts to rent of 3 lakh rupees. If I reduce the standard deduction, that comes to 2.1 lakhs. So because of this reason, Mrs. Sudha is not liable to file the return because her income is below the basic exemption limit. But Mr. Ravi, that is the husband, has given 30 lakh rupees gift to the wife, and wife has done what with that money? Wife has purchased the car of 29 lakh 52,000 rupees with that money, which includes certain charges like RTO charges, insurance charges, extended warranty charges and accessory charges. Now remove all these things. Remove RTO, remove insurance, remove extended warranty, remove accessory charges. After that, the ex-showroom price of the car comes to 26 lakhs 24,710 rupees. On this amount, the dealer will collect TCS. How much TCS is applicable on car under 2061F? It is 1%. Therefore, dealer will collect TCS not on extended warranty, not on accessory charges, not on RTO charges, not on insurance charges. He will collect on 26 lakh 24,710. That is, he will collect 26,247 TCS from Mrs. Sudha. Now, Mrs. Sudha, TCS is how much? 26,247. Therefore, remember, there is a provision under 139 which says that if your TDS or TCS is 25,000 rupees or more, if your TDS and TCS is 25,000 rupees or more, then you have to file the income tax return. Because of this reason, Mrs. Sudha has to file the income tax return. I hope it is clear to all of you. Now let's move on to the next question. The next question is on dispute resolution committee. Mr. Vijay has furnished his return declaring a total income of 28 lakh rupees. Then he received an assessment order on 26th of November 2025 where AO has enhanced the income by how much? By 5 lakh rupees. Now he's agreed by the AO's order. So he is making an application before dispute resolution committee. So he is making an application before what? Dispute resolution committee. There is no order of detention has been and no prosecution has been initiated. Just a small penalty under 271D has been levied for failure of certain provisions under 269SS. Now, the first question is Mr. Vijay can Mr. Vijay file an application before DRC? See, to file an application before DRC, you have to fulfill certain conditions. First of all, your total income as per return should be up to 50 lakh rupees. Is it up to 50 lakh rupees? The answer is yes. Similarly, the AO should not enhance your income more than 10 lakh rupees. Is the AO increasing the income by more than 10 lakh rupees? The answer is no. This condition is also fulfilled. Third condition, there should not be any detention order against you. There should not be any prosecution against you. Is there any detention or prosecution against you? The answer is yes. Can there be a penalty against me? Yes. Penalty, if it is initiated, that is okay. There is no restriction or imposition of penalty to go to DRC. Along with penalty, you can go to DRC also. Therefore, Mr. Vijay can file the application. Second question, what is the time limit? He has to file the application within 1 month from the date of receipt of assessment order. So, assessment order is received on 26th of Jan. He has to file an application by 25th of December 2025. I hope it is clear to all of you. If he is not happy with the order of the DRC, can he file an appeal? The answer is no. The order of the appeal is non-appealable. The order of DRC is not appealable. You cannot file an appeal against the order of DRC. It is not allowed to do that. Next, second part, would your answer be different if assessment order is based on information received under DTAA with country X? Yes, then he cannot opt for DRC. If the assessment is done by AO based on information received from foreign country under DTAA, then the assessee cannot go for DRC. I hope it is clear to all of you. Now the next question is a very simple question on DTAA. I'm not wasting my time on that. You can go through this question. It's a similar question what we have done earlier. If some different question of DTAA will come, I will definitely address with you. This is the same thing which is very, very similar to what we have done earlier. And last question of this RTP is a very different kind of question. Let me explain you this. Matrix Inc. is incorporated in country X and it holds 26% stake in Indian company Pilu Limited. And Indian company has declared a dividend of 50 lakh rupees. Now, as per the DTAA between India and country X, which was entered on 1st of Jan 2021, the dividend will be taxable at 15%. So between India and country X, the dividend income will be taxable at 15%. Now later on, we entered into DTAA with country Y, which came later on 15th of May 2021. In that, we did a provision. In that, we put a clause where we have said that it will be taxed at 10%. Now both X and Y are member of OECD since 2018 and 2020, that is before entering into the treaty. Now, what is the problem over here? There is some disparity over here. The country with whom we are entering first, we are charging 15% tax, and the country with whom we are entering later, we are charging 10% tax. So country X will get aggrieved with us, will be unsatisfied, will be unhappy with us. So therefore, can we apply this 10% on country X also? Yes, we can apply this 10% on country X also, with whom we have done DTAA earlier, subject to some condition. What is that condition? First of all, the second treaty is entered into after the entry into force of the first treaty. Similarly, the second treaty is entered into between India and a state which is a member of OECD at the time of signing the treaty. So at the time of signing the treaty, were both the country part of OECD? Yes, one was part of OECD since 2018 and another was part of OECD since 2020. Third, India limits its rights of taxation to 10%, whatever it is. And fourth, India should separately notify that particular thing in the income tax law. If these four conditions are fulfilled, the country Y benefit can also be given to country X. Okay. Now, would your answer change if the country Y had become OECD member only in 2023? Yes. Then we cannot give the benefit to that particular country X because this condition number 2 will be violated. The second treaty is entered into between India and a state which is a member of OECD. It is not a member of OECD. Therefore, this benefit cannot be passed on. Now, I hope it is clear to all of you. Now let's move on to the next RTP, that is the fifth RTP in our order, that is May 2023 RTP. See how fast we have moved on to the fifth RTP. Can you imagine doing so many RTPs in such a short span of time? It is absolutely impossible. Now the very first question over here is there is a partnership firm with 5 partners sharing profits and losses equally, and their case was selected for scrutiny. Now one of the partner has given, Mr. Raghav has given a loan of 50 lakh rupees to the firm. So I am the firm, you are partner, you are Raghav, I am firm. You are giving me 50 lakh rupees loan. Now the AO is asking me the source of income in the hands of Raghav. I am not able to explain the source of income in the hands of Raghav. So can the AO assess that particular 50 lakh rupees in my hands as deemed income? The question is, if a firm is receiving loan of 50 lakh rupees from partner, is the firm responsible to explain the source in the hands of partner? And the answer is yes. As per section 68, if I take loan from anybody, it is my duty to explain the source in the hands of the lender who is giving you the loan. If I'm not able to explain the source in the hands of the person who is giving me the loan, then it will be deemed income under section 68 cash credit, and that will be subject to 78% tax under 115 BBE. Check it please. How much tax will be imposed on me? 78% tax will be imposed on me plus 60% tax, 25% surcharge, 4% cess. That makes the tax to 78%. I hope it is clear to all of you. So it is my duty to explain the source in the hands of the person who is giving me as per section 68. Now question number 2. There is a company A Limited who has taken a loan from a public financial institution and there is an outstanding interest of 3.5 lakhs. So can I get the deduction of that outstanding interest? The answer is no. I have to make the payment as per 43B, actual payment. Now what the assessee has done? Assessee has converted this outstanding interest into a debenture. So conversion of an outstanding interest into a new loan or into a debenture or into any other security does not amount to actual payment. This is not actual payment. This cannot be called as an actual payment, and therefore this will not be allowed as a deduction. This will be disallowed under the income tax law. I hope it is clear to all of you. Now the third question talks about, we need to answer who all are liable to file the income tax return. Who is required to file the income tax return? First, Mr. Albert is there, whose total income is 2 lakh rupees. So a person whose total income is 2 lakh is not liable to file the income tax return. But wait. Albert is doing business and his turnover from business is 70 lakh rupees. Is he now liable to file the income tax return? And the answer is yes. Why? Because any person whose turnover is more than 60 lakh rupees in case of a business or more than 10 lakh rupees in case of a profession is liable to file the income tax return. Because of that logic, Albert is liable to file the income tax return. Question number 2. Ashish is 42 years old. His receipts from profession is 5 lakhs, but his profit from profession is how much? His profit from profession is 2.5 lakhs. Apart from that, he is also earning some FD interest of 4 lakh rupees and some saving bank interest of 5 lakh rupees. Therefore, his gross total income comes to how much? 7 lakh rupees. Therefore, is he liable to file the income tax return? Obviously, yes. If any individual HUF, AO, PVY whose gross total income is more than basic exemption limit, which is 3 lakh rupees, is liable to file the income tax return. I hope it is clear to all of you. Third case, a law firm. I will not read only ahead. A partnership firm or a company is always liable to file the income tax return irrespective of their total income or loss. Even if they are making profit or loss, it doesn't matter. They are always liable to file the return. So next question also, I will not read the question also. XYZ Private Limited. What they are doing, I am not interested. They are always liable to file the income tax return irrespective of their income, whether they are earning or whether they are not earning, whether they are profit, whether they are loss. I am not interested in that. They are liable to file the income tax return. And one last question. Mr. Valish is depositing 50 lakh rupees in his saving bank account. I am not interested in reading the question ahead. Why? Because if any person who deposits 50 lakh rupees or more in a saving bank account is liable to file the income tax return, and Mr. Valish is depositing how much? 50 lakh rupees in this case. Therefore, Mr. Valish is liable to file the income tax return. I hope it is clear to all of you. Now next question, question number 4. It's a beautiful question and dangerous question at the same time. Let me read the question first of all. ABC is a cooperative bank engaged in marketing of agricultural produce grown by its member. Therefore, ABC Cooperative Society is eligible for Section ATP deduction under the income tax law. Okay. Therefore, the profit from the activity is 60 lakh rupees. How much they are earning from marketing of agricultural produce grown by its member? 60 lakh rupees. Apart from that, they have also employed 10 new employees with a salary of 20,000 per month on 1st of May 2024. Salary is paid by account paycheck, and the firm and the cooperative society is eligible for audit under 44AB. Apart from that, they are also earning interest on fixed deposit of 32 lakh rupees from various banks. Now, there are multiple parts in this question. Compute total income and tax liability for AY 25-26. This is the first part. Second part, advise whether it should opt for 115 BAD. This is the second part. So let us compute the first part first. When we are computing the total income and tax liability of a cooperative society, we need to make two calculations. Which two calculations, sir? First, normal calculation, we have to make regular tax and AMT. Regular tax and AMT? Yes. While computing the normal tax, see, we need to make broadly two calculations as per normal provision and as per 115 BAD. When we are doing as per normal calculation, we have to do two calculations as per regular and as per AMT. Now, as per regular, we have to compute the total income first. What is the gross total income? 60 lakh rupees is the income from PGBP and 32 lakh rupees is the income from fixed deposit. Total 92 lakh. Now, while computing the regular provision, you will first compute ATP. ATP, you will get deduction of 60 lakh rupees, which is agriculture produce marketing grown by its members, that you can claim 60 lakh as deduction. And while computing ATJJAA, you will get ATJJAA deduction because 10 employees are there, multiplied by 20,000 rupees per month into 10 months, into 11 months from 1st May to 31st March into 30%. That will be your ATJJAA deduction. So that will be your, you will get both the deduction over here. After claiming both the deduction, your total income will come, you apply your slab rates. What is the slab rate for cooperative society? Up to 10,000 10%, about 10,000 20%, about 20,000 30%. And then surcharge if applicable and cess. Okay. Now you will compute tax as per what? AMT. While computing AMT, you have to compute the adjusted total income. What is adjusted total income? It is total income plus certain things. Now, while adding that, do not add ATP because on ATP, AMT is not applicable. Do you remember? On ATP deduction, AMT is not applicable. Yes, but while computing the AMT adjusted total income, you have to add back ATJJAA. On ATJJAA, AMT is applicable. Then you apply AMT 15%. Generally, AMT is 18.5%, but for cooperative society, AMT is only 15%. It is not 18.5%. I hope it is clear to all of you. This will be your, then you will apply the compute, the tax, and whichever is higher will become your tax number 1. Now you will compare that tax with 115 BAD. While computing 115 BAD, you will not claim ATP. ATP is not allowed. ATP is not allowed in 115 BAD. But yes, ATJJAA is allowed in 115 BAD. So you will take 60 lakhs as your PGBP, 32 lakhs FD. You will not claim ATP. You will claim ATJJAA. That will give you total income. 22% tax, 10% surcharge, 4% cess. That will be your final tax. Then compare this tax is better or normal tax is better. Whichever is better, you go for that. One more thing. While computing 115 BAD, AMT is not applicable. Therefore, in 115 BAD, you are going to do only one calculation. That is the normal tax calculation, not as per AMT, because assessee is opting for 115 BAD, AMT is not applicable. Now, there is second part of this question. What would be your answer if ABC Cooperative Society is a cooperative bank engaged in the business of banking? So if it is a bank, then how the answer will change? See, everything will remain same. If it is a bank, you will not get ATP. Remove ATP from everywhere if it is a bank. Okay, be very careful. Now, how will you compute the income now? If it is a bank, then again normal and 115 BAD. Again in normal two calculation, regular and AMT. And while computing the regular, you will claim ATJJAA. ATP is not allowed to banking industry. And while computing AMT, you will add back ATJJAA. Anyways, ATP was not disallowed under AMT. Then you will compute the tax as per applying the normal rates. Okay. And in 115 BAD also, you will not compute ATP. ATP is not covered. And in 115 BAD, you will get ATJJAA deduction is allowed under 115 BAD. Here also no AMT will apply. Rest everything will same. So if it is a cooperative bank, just remove ATP from everywhere. ATP is not applicable. You will only play with ATJJAA and ATP will be removed from everywhere. I hope it is clear to all of you. Now, moving ahead to the next question, question number 5. There is a LLP, Beta LLP, which is engaged in export of computer software through two units. Unit 1 is engaged in SEZ, therefore it is eligible for 10AA. Unit 2 is a DTAA unit, therefore it is not eligible for 10AA. This is the 5th year of business, therefore the assessee is eligible for 100% deduction under 10AA. Now, we need to compute what? We need to compute the total income and the tax liability of Beta LLP. So here also we need to compute tax as per normal provision first, and then we need to compute tax as per AMT, alternate minimum tax 115JC. Then whichever is higher, that will be your total income and tax liability. Now let's start with the normal provision. The profit of unit 1 is 710 lakhs, as you can see over here, and the profit of unit 2 is 840 lakhs. So I will write down that 710, 840. Now under unit 1, 41 lakh is disallowed. So I will disallow that 41 lakh first. And under unit 2, 55 lakh is disallowed. So I will disallow that under unit 2. So that much I will disallow first, and I will get to my profit. 1646 is my profit. Okay, this is my total income. From that, now I will claim 10AA deduction. For 10AA deduction, I want three things. That is, I want profit of unit 1. Unit 1 profit, I want profit from export multiplied by export turnover of unit 1 divided by total turnover of unit 1. Now I am not interested in unit 2. Only unit 1 is eligible for 10AA. Therefore, what is the profit of unit 1? The profit of unit 1 is 751, as you can see over here, correct? Out of that, I will remove two things. Which two things? Because profit shall not include duty drawback, profit on sale of import license. All these things are not part of profit. I hope it is clear to all of you. Therefore, I will remove duty drawback. I will remove profit on sale of import license. If I remove these two, I will get my profit as 666. Now I will compute my export turnover. While computing the export turnover, you will not take two things. First of all, only that export turnover you will take which is received in India within 6 months from the end of the financial year. Second, export turnover will not include insurance, freight and other charges. Therefore, what is my export turnover? It is 1800 rupees. But out of which how much is received in India? Only 1600 is received in India. Therefore, I will take only 1600. But out of 1600 also, 180 is attributable to insurance and freight. So I cannot take that also. Therefore, 1600 minus 180. 1600 is my export turnover received in India, out of which 180 is my insurance and freight. Therefore, I have to reduce that. Therefore, my export turnover is 1420. What is my total turnover? My total turnover is very straightforward. My export turnover is 1800. My domestic turnover is 300. Out of that, my 300 is my insurance and freight. Therefore, my export turnover is 1800. My domestic turnover is 300. Out of that, 300 is my insurance and freight. Therefore, this 300 gone. Therefore, total turnover is only 1800. Therefore, I got my total turnover as how much? Total turnover is 1800. Therefore, finally, I got the relevant data. 666 is my profit multiplied by export turnover 1420 and 1800 is my total turnover. Therefore, into 100% deduction, 525.40 will be my deduction. Therefore, 525.40 will be my deduction, and this is my total income. I hope it is clear to all of you. Now I will compute tax as per first of all normal provision and then as per AMT. 30% tax, 12% surcharge, since the income is more than 1 crore now, therefore 12% surcharge will impose and 4% cess will be applied. And then I will compute AMT. For computing AMT, what will I do? I will first take a total income plus 10AA. Total income plus 10AA. That will give me adjusted total income. On that 18.5% tax, 12% surcharge, 4% cess, and then compare whichever is higher. The higher amount is coming as this particular amount is coming higher, or this particular amount is coming higher. Whichever is coming higher, pay tax as per that. Okay. And if the AMT is higher, then there will be AMT credit. And if the normal provision is higher, then there will not be any AMT credit. I hope it is clear to all of you. Now let's move on to the next question. Question number 6. Let us read the last line. First of all, we are supposed to compute total income, tax liability, and we are supposed to compute total income as per 115BAA. Okay, so 115BAA, you have to keep it in mind. Okay. Now, assessee is a manufacturing assessee. Net profit is 930 lakhs. Very first adjustment, the opening stock and the closing stocks were overvalued by 10% and closing stock was undervalued by 10%. So opening stock is overvalued, closing stock is undervalued. So let's talk about opening stock. Opening stock is 60 lakhs and it is overvalued. It means it is 110%. Therefore, 10% is how much? Cross multiply, find out that. And if it is overvalued, it means you have taken over deduction. So add back opening stock, whatever is overvalued. Similarly, closing stock is undervalued. It means income is less. So add back again this 10%, cross multiply, add back this 10%. Okay, I hope it is clear to all of you. So the effect of both of them will be you have to add back to the net profit. Overvaluation of opening stock means what? Overvaluation of opening stock means you have taken more deduction. So add back to the profit. Undervaluation of closing stock is what? It means you have taken, you are showing less income. It means again you have to add back. Okay. Next one. You are making some payment of 65 lakhs on 15th of October to buy some know-how. Now, which is launched in November. Now, purchase of know-how is an intangible asset. Therefore, add back 65 lakhs and you claim 12.5% depreciation, 12.5% depreciation because it is used for less than 180 days. Okay. Third one is a very simple question on grandfathering. We have done multiple questions on grandfathering so far. One more time I will say, that is, you are selling some 2,200 shares of a listed company on which STT is paid at purchase and sale both. Therefore, it is covered in 112A. The profit is 2,97,000. So this is your accounting profit reduced from PGBP. But while computing the tax profit under LTCG under 112A, you have to follow grandfathering clause. How will you follow the grandfathering clause? Full value of consideration minus cost. What is cost? Cost is actual cost. Compare with lower of FMV on 31st Jan or sale consideration, whichever is lower. Then you will compare that with actual cost, and then whichever is higher, that will be your cost. And then up to 1,25,000 rupees, it will be exempt, and above 1,25,000, it will be taxable at 12.5% because it is sold on 27 November, which is on or after 23rd July 2024. From before 23rd July, it was 10%. From 23rd July, it is 12.5%. I hope it is clear to all of you. Next is electricity charges of 8 lakh rupees, which was unpaid. So can I get the deduction of electricity charges on an accrual basis? The answer is yes. Electricity charges is allowed on accrual basis. It is not covered in 43B. Therefore, you can claim that as a deduction. Next, there's a loss of 2.25 lakh due to hedging of what? Import of raw material. So you are importing some raw material. For that, you have entered into a hedging contract on which there is a loss of 2.2 lakh. So revenue loss, because it is for raw material, this loss is a revenue loss. Therefore, it is allowed as a deduction. Nothing to worry about it. Next one, depreciation as per books of accounts, you will add back. Next one, dividend from foreign company, you will reduce from PGBP and you will show under IFOS. I hope it is clear to all of you. Next one, you have received 32 lakhs from a company Zen Limited in the form of a non-compete fees. So non-compete fees is a part of what? Is a part of PGBP income. Therefore, let it be part of PGBP. Non-compete fees is always a PGBP income. Next, you have received some advance of 22 lakhs on sale of land, but the land did not get sold and therefore you have forfeited the advance. So now, if you have forfeited the advance on or after 1st April 2014, it is IFOS income. And if you forfeit before 2014, then the treatment was different. Now, on or after 1st April 2014, if you forfeit any advance in the process of negotiation of transfer of a capital asset and you did not transfer the capital asset, you forfeited the amount, it is income from other source. So you have to reduce from PGBP, you have to show under income from other source. Next adjustment, excess on sale of unlisted shares. So you will reduce this from PGBP and show that excess as a long-term capital gains. Why long-term, sir? See, the unlisted shares were purchased in 2017 for 80 lakh rupees. So it was purchased for 80 lakh rupees and you are selling at an excess of 18 lakhs. Therefore, 80 lakhs you are selling at an excess of 18. Therefore, the long-term capital gains will come to how much? 98 lakh rupees. This will be subject to 12.5% tax from 23rd July 2024. I hope it is clear to all of you. Next one, there is a loss of hedging contract on import of machinery now. So you are importing a machinery of 70 lakh rupees and there is a loss of 2 lakh rupees on hedging of that. So this loss will now be adjusted. First of all, you will disallow this loss to PGBP. It is not allowed under PGBP. It will be added to the cost of the asset. So 70 lakh is the cost of asset and you will add that to the cost of asset as per 43A. What is 43A? What does 43A says that? 43A says that when you import a asset and on which there is a foreign currency gain or loss, then on the date of payment, you have to adjust that loss in the WDV of the block of asset. Therefore, 70 lakh is the actual cost of the asset. 2 lakh is what? 2 lakh is the value of the loss. 72 lakh will become actual cost. On this, you will claim 7.5% depreciation because the asset is put to use for less than 180 days. It is put to use in November. You will not claim depreciation, additional depreciation, because additional depreciation is not allowed under 115BAA. Then normal depreciation of 35 lakhs, you claim as a reduction. Adjustment number 2 we have already done. And last adjustment is adjustment number 3, which is on 80JJAA. So listen carefully. 59 employees you have hired, out of which 36 employees were hired on 1st June with an emolument of 15,000 per month. So they will be eligible for 80JJAA. Similarly, 18 employees were hired for 35,200. They will not be eligible for 80JJAA because the emolument is more than 25,000. Similarly, 5 employees were hired on 1st of November. They will also not be employed for. They will also not be eligible for 80JJAA because they are not employed for at least 240 days in the previous year. The employees have to be employed for at least 240 days in a previous year. Otherwise, they are not eligible for 80JJAA. Therefore, only 36 employees are eligible. But out of those 36 employees also, the salary of 10 employees are paid by bearer check. So that will also not be allowed. You have to make the payment by 4 modes: account pay check, account pay draft, TCS and such as electronic mode. Therefore, only 26 employees are eligible for 80JJAA. 26 employees into 10 months into 15,000 into 30% will be eligible for 80JJAA. Wait. The 10 employees to whom you are paying salary by bearer check, they will also be disallowed under PGBP under 48.3 because you you are making a payment of salary to them of more than 10,000 rupees in bearer check. That is not allowed. So 10 employees into 10 months into 15,000, that will be disallowed under 40A3. Now you will compute your total income and total tax. Total income is 10 crore 10 lakh. So you will compute your total income. So 112A is coming to 0. Why? Because 112A capital gains is coming to 55,000. So entire 55,000 will be exempt, because up to 1.25 lakh it is exempt. Then 112 capital gains is coming to how much? 18 lakh rupees, on that 12.5%, and on balance income it is 22% tax, 10% surcharge, and 4% cess. I hope it is clear to all of you. Now question number 7 is exactly similar to what we have done in the first RTP, that is RTP first question. You can go and compare with that question. That question and this question is exactly same, except the names. The names might have changed. Rest all the things are exactly same. That is the reason I am not repeating that question here. Question number 8 is a very simple question. There is a fee and company engaged in providing scientific services to various non-resident clients. Such services are also provided to Zeta Inc., which guarantees 12% of the total loans of fee Inc. So if one entity provides 10% or more guarantee of the loan, then both of them are deemed to be associate enterprise. And if both of them are deemed to be associate enterprise, therefore transfer pricing provisions will apply in this case. Now, second part is, if the AO has made a primary adjustment of 310 lakh on 1/4/2024 and the same is also accepted by the assessee, and the money is not brought to India up to 31st March 2025 and the transaction is denominated in Indian currency, what are the requirements as per the Income Tax Act? See, very simple. You have to apply the provisions of secondary adjustment over here. So if the AO has passed an order of 1/4/2024 where the primary adjustment is more than 1 crore rupees, then the assessee has to bring back the money within 90 days from the date of order. If the assessee does not bring back the money within 90 days from the date of order, then secondary adjustment will apply. Secondary adjustment will apply how? 310 crore, 310 lakhs will be deemed to be a loan. On that, the interest will be applied. How much interest will be applied? SBI's MCLR 9% plus 3.25%. That is 12.25% interest will be applied on you for financial year 24-25. There is one more option available with you, that if you don't want to pay that interest, you pay one-time additional tax of 20.9664. If you pay one-time additional tax of 20.9664, then you will not be eligible for what? You will not be liable for what? Secondary adjustment. I hope it is clear to all of you. And this last question is also a very, very simple DTAA question. We have done a similar question earlier. This is a total income question on DTAA. Similar question we have done. Income from sole proprietor in business, income from partnership firm in Mumbai is exempt, then agriculture income from country X, then brought forward loss you have to set off against the business in India, then 1,50,000 you can claim under 80C, then you can claim 25,000 under 80D, then you can claim what? Health insurance of your parents also you can claim up to 50,000 rupees, so on and so forth. Then you can claim 20,000 rupees on medical treatment of disability, so you can claim 75,000 flat deduction for your handicap dependent relative. So it's a very simple question on DTAA. You can go through it once, nothing great as such. Whenever a new or a unique question of DTAA will come, I will definitely address that to you all. Okay. Now let's move on to the next RTP November 2023. The very first question over here is a question on total income and tax liability. Assessee is a manufacturer. The profit of the assessee is 180 lakhs. Now what is the total income of the assessee? The total income and tax liability we have to compute, and we need to always see the last line, that whether we have to opt the special regime or not. So we have to follow as per 115BAA. Okay. So let's start the question. The very first adjustment over here is the assessee is paying some interest of 24 lakh rupees by giving debentures. So is it allowed? Can I convert my outstanding interest into a debenture and then I can say it amounts to actual payment? The answer is no, it is not allowed as deduction. As per section 43B, it is disallowed. Next is some tax assessment has been done and the demand has been raised of 5,80,000, which includes surcharge and cess also. So it doesn't matter, income tax is disallowed, surcharge is also disallowed, and cess is also disallowed. All of them will be disallowed under section 40 clause A. Next, provision for payment of gratuity as per actuarial valuation is disallowed under 40A7. So whatever provision you make for gratuity, that is disallowed. That is absolutely disallowed. Even if it is made by actuary, then also it is disallowed. However, if the gratuity is actually paid, which you can see in the last adjustment, whatever gratuity is actually paid, that is 105 lakhs, that will be allowed as deduction. You can take deduction of 105 lakhs. So you have to reduce 105 lakhs and you have to add back what? 180 lakhs. Next, directors are going to some foreign country for some opening of some new branch. So that is for business and profession. So if a director is going to foreign country for opening a new branch, that is obviously for business and profession, and therefore that will be allowed as deduction. This will be allowed as deduction. Next, You are paying some 82,000 rupees for purchase of raw material on 26th Jan, which is a public holiday because of Republic Day, and you are making the payment unfortunately in cash. So can you make the payment in cash on public holiday? Absolutely no. Holidays have nothing to do with under the income tax law. Even on public holiday, you have to make the payment by other than account pay. You have to make the payment by account paycheck, account pay draft, TCS, and electronic mode if the payment is more than 10,000 rupees. Therefore, this 82,000 rupees will be disallowed. Next one is a foreign company which is in Japan. That foreign company is providing some online advertisement services to us. That foreign company does not have a P in India, and we are making a payment of 11 lakh rupees to that foreign company. Therefore, it is a classic case of what? It is a classic case of equalization levy. The Indian company should have deducted equalization levy, and if equalization levy is not deducted, the expenditure will be 100% disallowed. Next, 4.6 lakhs you are paying as a CSR expense. CSR is not allowed under section 37(1). Next, you are selling some land to an wholly owned subsidiary Indian company. So if you sell anything to your wholly owned Indian subsidiary, it is 100% exempt. It is not subject to capital gains. Therefore, reduce from PGBP and show as exempt under capital gains. Next, you are giving some donation to Scientific Research Association, partly in kind, partly in online, partly in cash. Absolutely disallowed, entirely disallowed. Why? Because in 115BAA, donation is not allowed as a deduction. Therefore, this is fully disallowed under the income tax law. Next, you are earning some, you can see point number J and point number M together. You are earning a dividend of 36 lakh rupees. So you will reduce this dividend from, first of all, from PGBP, and you will show this dividend as income under IFRS. At the same time, you are distributing a dividend of 65 lakh rupees. Therefore, this 65 lakh rupees compared with the dividend received, whichever is lower, will be allowed as deduction under ATM. Under ATM, you can claim the deduction of dividend received or dividend distributed 1 month prior to the due date of filing of return. Whichever is lower will be allowed as deduction. I hope it is clear to all of you. Next adjustment is a very important adjustment for your exam. That is, the employer is contributing some amount to notified pension scheme. Now, how much is allowed to the employer? It was allowed to the extent of 10% of salary plus DA in terms earlier, but now Finance Act 2024 has made an amendment. The 10% percentage has been increased to 14%. So now 14% will be allowed. So company has contributed 60 lakh rupees towards the employees pension scheme. That amounts to 15% of salary and DA in terms, but only 14% is disallowed. Therefore, 1% you have to disallow. Okay. Then depreciation of 36 lakhs will be disallowed because that is as per books of accounts. Donation to political party not allowed under 115BAA. Normal depreciation you can claim under 115BAA. Additional depreciation you cannot claim under 115BAA. Brought forward UAD out of normal depreciation will be allowed under 115BAA, but UAD out of additional depreciation will not be allowed under 115BAA. Now this UAD is out of normal depreciation, therefore you can take the deduction of this. Okay, if it would have been out of additional depreciation, you cannot take the deduction. I hope it is clear to all of you. After that, you have to just compute tax, 22% tax, 10% surcharge, and 4% cess. That's it. This is what this question is all about. Next question, beautiful question on TDS. Part 1 TDS and TCS both are included in this. Part 1 talks about very important aspect. Suppose I am a seller, you are a buyer. Listen carefully. I am a seller, you are a buyer. And if I am selling you coal, the Sasi is selling coal. If I am selling you coal, then I should collect TCS under 206C subsection 1, the first section of TCS. But if the buyer is a resident and buyer gives a declaration to the seller that he will be using the coal for manufacturing or power generation, he will not be using the coal for trading purpose, but for manufacturing and power generation he will be using, then the seller cannot collect TCS. Seller cannot collect TCS. 206C subsection 1 is not applicable in that case. But there is another catch in that. Then the buyer has to deduct TDS under 194Q subject to some conditions which they have to fulfill. But buyer has to deduct TDS. But in this case, the seller will not collect TCS because the seller is selling to a buyer who is using for manufacturing or power generation. But the buyer will also not deduct TDS. Right? The reason is the buyer has incorporated the business in the current year, and for applicability of 194Q, your last year's business turnover has to be more than 10 crore rupees. Only if the last year's business turnover is more than 10 crore rupees, then only it is allowed. Otherwise, it is not allowed. So therefore, because it is incorporated, it is incorporated in the current year. Therefore, the last year's business turnover is 0 rupees. Therefore, the provisions of 194Q are not applicable over here. Now, the one more question they are asking: would your answer change if Delta was incorporated in the last year? Suppose Delta was incorporated in the last year and the turnover was 10 crore. Again, the answer will not change. Again, 194Q will not apply, because for 194Q to apply, the last year business turnover has to be more than 10 crore rupees. Exact 10 crore is not sufficient. I hope it is clear to all of you. Next question is also a beautiful question. Sigma is a car manufacturer. It is selling some cars to the car dealers. So remember, whenever a car manufacturer sells car to the car dealer, then the provisions of 2061F is not applicable to the seller. 2061F is not applicable. Now you need to check, if the buyer's last year turnover is more than 10 crore, then the buyer will deduct TDS under 194Q. And if the buyer's turnover is not more than 10 crore, and if the seller's last year turnover is more than 10 crore, then seller will collect TCS under 2061H. So in case of car, first follow 1F. If 1F is not possible, then 194Q. If 194Q is also not possible, then 1H will be applicable. So in this case, 1F is not applicable. Now, there are two buyers. Epsilon's last year's turnover is more than 10 crore. Therefore, in case of Epsilon will deduct TDS under 194Q in excess of 50 lakh rupees. In case of Omega's last year turnover is just 9 crore. But, so in that case, Sigma's last year turnover is 12 crore. Therefore, Sigma, that is the seller, will collect TCS under 2061H. I hope it is clear to all of you. Now, coming to the third question, which is on case law. Beautiful case law it is. What is this question all about? This question is about, there is an airline company and there are agents of the airline company. Now, the question is, when the airline company will deduct TDS on commission, whether they will deduct TDS on standard commission as well as supplementary commission, or only the standard commission. So the court has said that the TDS will be deducted on both standard commission as well as supplementary commission under 194H at the rate of 2% from 1st October 2024, and before 1st October it was 5%. I hope it is clear to all of you. Next one is the assessee, Mr. Ram. Mr. Ram has filed his return of income. Original return was filed for AY 21-22 on 28th of December 2021, and he has declared an income of 12 lakh rupees. And for AY 22-23, they are declaring a loss of 5 lakh rupees. Now Mr. Ram wants to file an updated return for the AY 22-23, and they want to declare the income of 7 lakh rupees. So earlier, what was the income? Earlier the income was 5 lakh loss. Now he wants to declare positive 7 lakh. Can an updated return be filed? The answer is yes. If there was a loss in original return, and if you want to increase that loss and show that as an income as a positive income, then you can file the updated return. If you want to show loss as a loss, then you cannot file updated return. If you want to increase the income, then you can file updated return. By when you can file? If you file within 12 months from the end of the relevant AY, you will be liable for 25% additional tax, and if you file after 12 months from the end of the relevant AY, then you will be liable to file, you will be liable to pay 50% additional tax. In this case, the assessee is filing on 30th November 2023, which is within 12 months from the end of the relevant AY. You can check it. Therefore, assessee will be liable for 25% additional tax. Okay. Now, next question: what would be the time limit for completion of assessment? See, in case of AY 21-22, updated return is not filed. So in that case, the time limit to complete assessment is 12 months from the end of relevant AY. But in case of AY 22-23, updated return is filed. So in that case, it will be 12 months from the end of the financial year in which the updated return is furnished. So it will be end of the financial year of 23-24. From the end of 23-24, within 12 months, the assessee has to file the income tax return. Next question: there was a search in case of assessee by the assessing officer, and some undisclosed income was found. Now the assessee wants to set off the loss and brought forward unabsorbed depreciation against this undisclosed income. So can a loss or unabsorbed depreciation be set off against the income determined under search and seizure? And the answer is no. That is not allowed as per section 79A. 79A disallows that. 79A does not allow such kind of set off against the income which is found in the search and seizure. Okay. I hope it is clear to all of you. Next one. Question number 6 is a beautiful question on case law which talks about determination of arm's length price. Now we all know that determination of arm's length price is a question of fact. Obviously, in determination of arm's length price, there is a lot of facts which are involved. Therefore, it is a question of fact. So, if anybody is aggrieved, can they go to High Court to challenge the arm's length price? That is the question. Because in High Court, you can only go if there is a question of law. You cannot take a question of fact in the High Court. Can I go to High Court by challenging what? By challenging the arm's length price. So, therefore, in this case, the court has held that yes, you can go to High Court by challenging the arm's length price. The High Court will not determine the arm's length price. High Court will not tell the department that find out the arm's length price, or High Court will not tell the department that go and check whether the uncontrolled price is correct or not, go and check whether the third party price is correct or not, go and check whether the data is correct or not. High Court will check whether the arm's length price is determined as per the provisions of income tax law or not. High Court will check the applicability of the income tax law. High Court will check the applicability of what? Whether the provisions of different provisions of 92C and its rules, whether they are applicable properly or not. Therefore, High Court has the power to check the arm's length price. Not the computation of arm's length price will be checked by High Court. High Court will only be involved in checking what? High Court will only be involved in checking the genuineness whether the arm's length price has been determined as per the law or not. Only that will be checked. They will not sit and compute the arm's length price. Okay, this is what it is written over here. Now this is a very simple question, nothing great as such. There is a resident person of 45 years, 45 DTAA question, simple question. Basic salary 62,000. Assessee is following old regime. You can check over here. Therefore 62,000 salary, 10% of the basic will be considered as dearness allowance, and then 50,000 rupees standard deduction under old regime, and under new regime it is 75,000 rupees standard deduction. Then royalty of 9,80,000, 98,000 rupees will be expense, 2,80,000 rental income, 30% standard deduction, and then dividend income of 2,20,000 rupees. Further, the assessee has purchased some house in Bhopal of 23 lakhs, on which 1% stamp duty is paid. So 1% stamp duty 23,000 will be allowed as deduction under 80C. Stamp duty paid for purchase of house is allowed under 80C. Then the assessee is paying some 26,000 health insurance. So 25,000 will be allowed because the assessee is not senior citizen. Then 50,000 is incurred as a health insurance on non-resident father who is not dependent on him. So on non-resident father, 50,000 will not be allowed. 50,000 is only allowed for resident fathers. Okay. Similarly, that's it. Then you have to follow the compute the tax of Mr. Raj and net tax liability, and then you have to follow the doubly tax income, apply the foreign country rate, whichever is lower, or Indian rate, whichever is lower, that will be allowed as what? That will be allowed as relief under section 91. And one last question has been removed by ICI because this is based on equalization levy under section 165A, and we all know that equalization levy, I have told you in the class also, equalization levy under 165A is not applicable from 1st August 2024, that is after the amendment made by Finance Act 2024. So it was applicable till 31st July, but from 1st August it is not applicable, but ICI has removed this completely from their study material. Therefore, we are not going to do any question on equalization levy under 165A. Yes, we will do the equalization levy under 165, that is the online advertisement one, but we are not going to do the 165A one. Okay. Then the last question over here is, there is a foreign company who has opened a branch in India for sale of LED lights. Now, they have opened a branch in India. Now, they are charging some profit of 40% on cost. Now, they are directly also selling some goods from there. So listen carefully. They are selling some goods from the Indian branch, and some goods they are directly selling from their Germany branch. Okay, from their Germany directly they are selling some goods. So whether the goods that is directly sold from Germany, will that also be taxable in India? That is known as force of attraction. That is only taxable under UN model. Remember, that is given under Article 7 of DTAA. Go and check the Model Convention chapter. So if there is a force of attraction applicable, then the goods which are directly sold from the foreign country will also be covered in India. So that is only applicable in UN model. In UN model that will be taxable. In OECD model that will not be taxable. I hope it is clear to all of you. Now let's go on to the next RTP, that is RTP May 2024. Now in this question we need to compute lot of things because the question in the last line says a very dangerous thing. Compute total income tax liability in the most beneficial manner. In the most beneficial manner means we need to make three computation here. First computation will be comprising of two computation and then one separate computation. Let me explain you how. First, you have to compute the tax as per the normal provision. Under the normal provision, you have to compute the tax as per the normal provision as well as per the MAT, because they have given us the book profit also over here. So first you will compute normal provision tax, MAT tax, whichever is higher, that will be your tax number one. Then you will compute tax as per 115BAA or BAB as the case may be, special provision. And then you will compute the tax as per 115BAA BAB, and then you will compare with the first tax, and then whichever is lower, that will be the most beneficial one. So this is how you are going to make three computation over here. First we will do the calculation as per the normal provision. Okay, let's start. The assessee is a manufacturer, it is a company. It is selling some pharmaceutical product. The net profit is 900 lakhs. Therefore, the first adjustment is the assessee has purchased some know-how of 50 lakh rupees in November 2024. Therefore, this is not allowed as deduction. It is an intangible asset. Therefore, you have to add back this and you have to claim 12.5% depreciation because it is used for less than 180 days. Next, electricity charges of 7 lakh not paid. So it is allowed. Electricity charges are allowed on accrual basis. Electricity charges are not covered under 43B. Next, there is some loss of 4 lakh rupees on import of some raw material due to hedging contract. So raw material is a revenue item, therefore loss on import of raw material due to hedging is because of revenue item, and therefore it is allowed as a revenue loss. You can claim that as a revenue loss. Okay. Next is a depreciation as per accounts 45 lakhs, you have to add it back. Next is a very important adjustment. There is a loss of 2 lakh rupees again due to hedging contract, but now due to import of machinery, that is because of import of asset. So first of all you will disallow this 2 lakh rupees because it is a capital loss, and you will add back this 2 lakh rupees to the cost of asset. The cost of asset, the cost of machinery is 65 lakhs. You will add back this 2 lakh rupees to 65 lakhs. Therefore, the actual cost of the machinery will be 67 lakhs. And then you will claim 7.5% normal depreciation and 10% additional depreciation because the machinery is put to use for less than 180 days. Okay. I hope it is clear to all of you. Next one, why additional depreciation we are claiming? because right now we are computing as per the normal provision, not as per 115BAA. Next one, you have received 20 lakh rupees as a non-compete fees, so that is a PGBP income, let it be part of PGBP. Next one, you have received 20 lakh rupees as an advance, but you have forfeited that advance. So do you remember, if you forfeit any advance on or after 1st April 2014, then it is considered to be an income from other source. Therefore, you have to reduce this 20 lakhs from here and you have to show this 20 lakhs as income from other source. Next one is excess on sale of unlisted shares. How much it is? 15 lakhs. Now, what is the cost of the shares? You can see below in additional information, the cost of the share is 80 lakh rupees and the excess is 15 lakh rupees. So what you do is, first of all, reduce this excess from PGBP and then show 95 lakhs as long-term capital gains, 80 plus 15 as long-term capital gains under capital gains, and that will be subject to 12.5% tax because this is sold on after 23rd July. Last but not least, 35 lakhs is your normal depreciation. You can claim that. That's it. Now, what will be the tax rate of this company? The tax rate of this company will be 25% because the turnover of this company of last year is below 400 crore. It is 282 crore. Therefore, the tax rate will be how much? The tax rate will be 25%. Therefore, apply 25% tax on normal income, apply 12.5% tax on long-term capital gains, and then 7% surcharge because the income is more than 1 crore up to 10 crore, and then 4% cess. I hope it is clear to all of you. This is your normal tax. Now you have to compute the tax as per 115JB. They have directly given us the book profit is 15 crore 20 lakh rupees. You can see in the question the book profit is given as 15 crore 20 lakh rupees. On that you will apply 15% MAT, 12% surcharge because the income is more than 10 crore and 4% cess. That's it. Now we have to compute the income as per 115BAA or BAB. Let's see which section is applicable. 115BAB is not applicable because the company was set up in 2015. For 115BAB, for 115BAB, the company should be set up between October 19 to March 24. Therefore, you can take 115BAA. 115BAA is available to everyone. And now in 115BAA, nothing should be done. Just one change will be there. That is, this is your total income as per the normal provision. You have to just add back one thing, and that is what? That is your additional depreciation. That's it. Once you add back additional depreciation, no other change is required. Everything is same under 115BAA and under the normal provision. Just add additional depreciation and then compute tax. On long-term capital gains 12.5%, on other income 22% tax, and then surcharge on the total tax of 10%. Always it is applicable, and 4% cess. I hope it is clear to all of you. And then compare whichever tax is coming lower, you should go for that. Okay. If normal tax is coming lower, go for that. If 115BAA is coming lower, then that will be the most beneficial one for you. Now, the next question is a theory question. There is a Commissioner of Income Tax who has issued a notice to assessing officer for conducting the proceedings of 263, that is revisionary proceeding. Now, after issuing the notice, there was a survey conducted at assessee's place. Now, after the survey, try to understand the sequence of event. First, the commissioner has sent a notice to the assessing officer for conducting 263. Then survey has been conducted, and now after the survey, the commissioner is sending second notice, the content of which is different from the first notice. The content mentioned in the first notice is different. The grounds mentioned in the first notice is different. The ground mentioned in the second notice is different. Can the commissioner do so? And the answer is no. It is written over here. The commissioner does not have the power to change the content like this after the survey. I hope it is clear to all of you. Next one is a question on black money law. Now remember, black money law is applicable only if the assessee is resident in the current year, or if the assessee is not resident in the current year, then assessee has to be resident in the year in which the asset was acquired, or if the asset was or in the year in which the income was earned. Again, I am saying black money law is only applicable either you should be resident in the current year in which the AO has found the income. Suppose the AO has found the income in current year 23-24 or 24-25, then you should be resident in current year. So if you are not a resident in current year, you are non-resident, then you should be resident in the year in which the income was found or in which the asset was acquired. So be very careful. Now there is an assessee over here who came to India in March 2013. Before that, he was outside India, and now then he went back out of India in March 2020. Therefore, from 2013 to 2020, he was in India, and in the current year he is not in India. So in the current year he is non-resident, but from 2013 to 20 he was in India. So whatever assets were acquired between this period and whatever income is earned during this period, that will be subject to tax under black money law. Let's see. First of all, he is acquiring some shares in United States company on 10 December. That will not be subject to tax because in 2012 the assessee was non-resident, and in the current year also he is non-resident. Therefore this will not be subject to tax. Then he acquired one apartment in London in April 2014. So in 2014 he was resident in India. Therefore this apartment will be subject to tax in India. Third, he has a business of manufacturing of leather goods that was started in 2020 April, and 2020 April, that is 2021, he was non-resident in India, and even today he is non-resident in India. Therefore this will not be subject to tax. I hope it is clear to all of you. Next one. He has also taken some commission from various buyers from April 13 to March 2020. Now, April 13 to March 2020. Remember, I have told you in class that the undisclosed foreign asset is chargeable in the year in which the AO found the asset, but the undisclosed income is chargeable to the respective year to which it pertains. Now, therefore, commission will be chargeable to the respective year to which it pertains. Therefore, 2013's commission will not be subject to tax. Why? Because the black money law came in 2015. How can you charge in 2013? How can you open the assessment of 2013? That is not possible. Therefore, 2013, 2014 commission cannot be subject to tax. 2015 to 2020 commission will be subject to tax in the respective year. 2015, 16, 16, 17, 17, 18, 18, 19, 19, 20. I hope it is clear to all of you. Is this clear? Next one is a beautiful question on DTAA. Be very careful, okay? In this question, it is not a question on unilateral relief. It is question on a bilateral relief. That is the reason, because it's a different kind of question. We are going to address this question. Mr. A is aged 50 years. He is working in a company Silver Limited since 2020. Now, assume Mr. Mahesh pays tax as per 115 BAC. It means he is paying tax as per what? As per the new regime. Therefore, let's start. Salary before deduction is 23 lakhs. New regime deduction is how much? 75,000 from Finance Act 2024. Then interest on self-occupied property not allowed. Under new regime, SOP interest is not allowed. Then fixed deposit, you can claim 1,60,000 as an income from other source. Now, he's earning some income from country A, but in dollars. So we have to convert that into rupees as per Rule 115. If you want to convert a foreign income into Indian income, you have to follow Rule 115. Now, he's earning some business income of $25,000. So business income will be converted as per TTBR on the last day of the financial year. Now, what is the TTBR on the last day of the financial year? You can check over here. It is 71 rupees. So you will convert this into 71 rupees into 25,000. Rental income will also be converted as per TTBR on the last day, but you have to compute the income from house property first. 4,500 is the rent minus municipal tax will be allowed as deduction minus 30% standard deduction. You have to claim all these things. Okay. I hope it is clear to all of you. After that, whatever income is coming, again, last day TTBR 71 rupees. Then dividend from foreign company will be considered to be, will be converted as per, not last day of the TTBR. For dividend income, the law says last day of the preceding month. So dividend is earned in March. So now for dividend, you will take the TTBR of February 28. Similarly, for short-term capital gains, you will take TTBR of the last day of the preceding month. The dividend, the short-term capital gain is earned on 28th of March. You will take TTBR of 28th Feb 2025. You will convert this and then you will compute the total income. The total income is coming to 54,11,290 rupees, and then you will compute tax as per the new regime. Then you will compute the tax as per new regime. Then you will apply some surcharge also, because the income is more than 150 lakh rupees and it is up to 1 crore. Because the income is more than 50 lakhs, it is up to 1 crore. You will apply the surcharge, 4% cess, and then you will find out the average rate in India. How will I find out the average rate in India? The average rate in India is very simple. What is the tax in India? 15 lakh 0502,515. This is the tax in India. What is the income in India? 54,11,290. If I divide this, the average rate in India comes to 27.77%. Now you will apply this on doubly taxed income. What is doubly taxed income? Let's see. The doubly taxed incomes are as follows. First of all, this amount is doubly taxed income. What is doubly taxed income? This house property is doubly taxed income. Then profits and gains is doubly taxed income. Then this capital gains is doubly taxed income. Then this dividend is doubly taxed income. If I total all of them, I will get 30,26,285. This is doubly taxed income. I will apply the average rate in India. Now I will compare with the tax paid in country A. How much tax is paid in country A? Let's check that also. It is written in the question. Income tax was paid by Mahesh on 25th of May 2025 for all incomes ended 31st March 2025 in country A. Rate of tax is 20% in respect of all incomes. Now, how much tax Mahesh has paid? On municipal property, municipal tax, Mahesh has paid tax on this amount. Because in country A, municipal tax is not allowed as deduction. Therefore, Mahesh has paid tax on 4,500. Mahesh has paid tax on Mahesh has paid tax on this also. Okay, on this also $25,000. Just compute it. 4,500 plus $25,000. Then Mahesh has paid tax on this $5,000. Just compute it. Then Mahesh has paid tax on this $10,000. How much it is coming? Mahesh has paid total of 45,500 income. On that, Mahesh has paid 20% tax. Now this will come the tax in foreign currency. Now if you want to convert if you want to convert a foreign tax into an Indian tax, then you have to apply Rule 128. And what does Rule 128 says? That you have to convert that into Indian rupees by taking TTBR of the preceding month last day. When it is paid in May 2025. So you have to take the preceding month last day, 30th April 2025 rate, and 30th April 2025 rate is 72 rupees. You can check in the question, and that amounts to 640,800. And then whichever is lower will be allowed as relief, and that much will be allowed as deduction out of 15,02,000, and balance you have to pay out of your pocket. I hope it is clear to all of you. The next question number 5, is on transfer pricing, arm's length price, determination of arm's length price as per advance pricing agreement and as per rollback provision. In this question, we need to answer for which of the following year the assessee can go for rollback. Let's check the question first. The assessee is engaged in a business of manufacturing of electronic goods across India and across Southeast Asia. The report was furnished for all the years on time. The company has applied for advance pricing agreement with on 15th of February, and the agreement was signed on 5th of May. The company has also applied for what? Rollback provision, and the agreement was signed on January 2025. Now we need to answer for which all years we can go for rollback. Can we go for rollback for AY 1920? No, you can go for rollback only for the preceding 4 years, and 1920 go beyond 4 years. Can I go for rollback for 2021? No, even 2021 go beyond 4 years. So beyond 4 years you cannot go for rollback. Can I go for 21-22? The answer is yes, you can go for 21-22. Can I go for 22-23? The answer is yes, you can go for 22-23. But sir, in 22-23 the assessment is completed and the arm's length price has been announced. It doesn't matter, all those things doesn't matter. The AO should not reduce the arm's length price below the returned income. If it is below the returned income, then you cannot go for what? The rollback provision. If it is above the returned income, you can definitely go for what? Rollback provision. Next one is a very important point. For 23-24, the matter has been went to tribunal and tribunal has remanded back the case to assessing officer. Can I go for rollback? Absolutely, you can go for rollback. If the tribunal has remanded back the case to AO, you can definitely go for rollback. But if the tribunal has not remanded back the case to AO, but tribunal has itself closed the matter at its end, if itself has achieved finality, then the assessee does not have the power to go for rollback provision. And in case of the last case, the assessee has not filed the return on time on 29 December 2024. If you are filing the return, rollback is not possible. One of the important conditions of rollback is if you want to roll back, you have to file the return of the rollback years on time. Otherwise, you cannot roll back in that particular case. I hope it is clear to all of you. Now let's start with the next RTP. This is a beautiful RTP and it's a very big RTP as well. Now pay attention. Very first question is similar to what we have done in the last RTP also. This is an Indian company engaged in manufacturing of certain products, and we need to find out the total income of the company, and we need to also find out the optimum income tax liability. So now we need to make multiple computation, 3 computation. First computation as per the normal provision, then as per MAT 115JB, then whichever is higher, then you will go for 115BAA or BAB as the case may be. Okay, the way we have done in the past RTP. So the very first thing that we will do is we will compute as per the normal provision. Let's start. So Indian company, the net profit of the company is how much? It is 95,45,000. The very first adjustment over here is the company is paying 6 lakh rupees for public issue expenses. So public issue expenses are considered to be a capital expenditure, therefore that is not allowed. Now even though the public issue could not be materialized due to SEBI, still it is not allowed because the intention of the company was to raise money. The intention of the company was to do public issue, therefore the expenditure is considered to be capital expenditure. It is not allowed as an expense. Okay. Next one, you are purchasing goods of worth 5 lakh rupees from a micro enterprise. Now there is an amendment under 43B which says that if you purchase anything from micro enterprise or small enterprise, then you have to make the payment within the time specified in the MSME Act. So if you pay within the time specified in MSME Act, then it is allowed on accrual basis. If you pay after the time specified in MSME Act, then it is allowed in the year of payment. Okay. Now what is the time specified under the MSME Act? If there is an agreement between both the party, that is the buyer and the seller, then the payment has to be made within the agreed period or 45 days, whichever is earlier. Now there is an agreement between both of them that they will make the payment in 25 days. Therefore the payment has to be made in 25 days. It has to be made in 25 days. If it is paid in 25 days, it is allowed on accrual basis. If it is paid after 25 days, then it is allowed on payment basis. Now let's see when the payment is made. The purchase was made on 25th of Feb and the payment is made on 29th of March. Therefore it is beyond 25 days. It is beyond the time limit specified in MSME Act. Therefore, it will be allowed on payment basis. Therefore, it will be allowed in the year of payment. But fortunately, what is happening over here? The year of payment itself is falling in the same financial year. Now, because the year of payment itself is falling in the same financial year, you don't have to worry. You will get the deduction of this particular amount. I hope it is clear to all of you. Next one, a pharma company giving freebies to medical practitioner. It is not allowed as per explanation to 37.1. Next one, depreciation as per the accounts, as per books of accounts will be disallowed. Next one, you are purchasing some one-time license fee. Now, you are purchasing that on 17th of September. Now, that will be disallowed under the income tax law, and 25% additional 25% depreciation will be allowed because the asset is used for more than 180 days. Next is you are purchasing some warehouse you have purchased some warehouse for storage of sugar. Now this is a classic case of 35AD, and from that you have earned a profit of 17 lakh rupees. Now this profit is obviously credited to the PNL, so you have to reduce this profit from the PNL and you have to show that profit of 17 lakhs separately, because that cannot be merged with your existing business. 35AD business has to be computed separately. Next, you are receiving some power subsidy of 5,30,000, so this will be taxable. Power subsidy is taxable in the year in which it is received, so in the current year if it is received, then it is taxable in the current year itself. Next one is a very routine adjustment, grandfathering clause. You have sold some shares on which STT was paid, the shares are listed, therefore it's a case of 112A, and the shares are long-term capital asset. Therefore this 4,80,000 from sale of shares will be reduced from PGBP, and for the purpose of computing capital gains, you have to follow the grandfathering clause and compute the capital gains. We have done this lot of time, okay? Then you have taken a working capital loan, and now you are going to the bank. You have taken the loan from a Punjab National Bank. Now you are going to the bank for settlement of that particular loan. Now when you went to the bank for settlement of the loan, the bank has waived that loan. 6 lakh rupees is waived in the form of principal, and 2 lakh rupees is waived in the form of outstanding interest. So what is the treatment of this? Now the principal which is waived will be considered to be deemed income because it's a remission and cessation of a trading liability. Working capital loan is a trading liability, therefore it is a remission and cessation of a trading liability. But interest which is waived will not be considered to be taxable as your income. Why? Because the interest was not allowed as deduction earlier, because interest is not allowed on accrual basis. If interest was not paid earlier, then it would have not been allowed earlier. So now on writing of that interest, on waiving of that interest, that should not be chargeable as income also. Last but not least, few additional informations are given over here. 50 new additional employees are hired on a regular basis on 1st of July 2024. 23,000 is the emolument of those employees, though they participate in the recognized provident fund, and the payment is made by account paycheck. So you can claim 80JJAA 23,000 rupees into 50 employees into 9 months from 1st July to 31st March into 30%. That will be your deduction under 80JJAA. Next is company has invested 40 lakh rupees in the warehouse for storage of sugar. Now this is related to 35AD business, but out of that 40 lakh rupees investment, 25 lakh is land. So land is not eligible for deduction. Only building will be eligible for deduction. Therefore only 15 lakh will be allowed as deduction. So out of 40 lakhs, only 15 lakh will be allowed as deduction. Now, what was the profit from storage of sugar? It was 17 lakh. And what is the expenditure? 15. Therefore, 2 lakh is the profit from 35AD business. I hope it is clear to all of you. Then depreciation is 9,20,000 rupees. And then the turnover of last to last year is 395 crore. Now, because the turnover of last to last year is up to 400 crore, therefore your tax will be 25%. Now you will compute your tax. Okay. I hope it is clear to all of you. This will complete your first part. Now, 112A will be subject to 12.5% tax. The 1,25,000 is exempt, and above 1,25,000 you will be subject to 12.5% tax. Now we will also compute now book profit. Book profit is 99,50,000 directly given in the question. On that 15% tax, 4% cess surcharge will not be imposed because the income is less than 1 crore rupees. Now we will follow the special tax regime. We will follow 115BAA. Sir, why are we not following 115BAB? 115BAB is not followed because 115BAB is only allowed to those associates who are engaged only in manufacturing. Now this associate along with manufacturing is also doing point number F. It is also engaged in warehousing of sugar. Therefore, it is not eligible for 115BAB. Therefore, it will be eligible for only 115BAA. So in 115BAA, how the things will differ? The things will differ in the following manner. Whatever is the total income as per your normal provision, you just have to add back 35AD business. 35AD deduction is not allowed under 115BAA, but yes, you can claim depreciation of 10% on that particular building which you are purchasing. So what is the building you are purchasing? 15 lakh. So 15 lakh deduction, you have to disallow that under 115BAA, but on that you will claim 10% depreciation. After that, again the same rule, the 112A will be chargeable at 12.5% after 1,25,000 rupees, and balance income will be subject to 22% tax, 10% surcharge, and 4% cess. And then you compare your tax, whether this is beneficial or that, whichever is more beneficial, you go for that. Okay. So let's go ahead with the next question. This is also a beautiful question. This is a partnership firm in which there are 3 working partners and 1 non-working partner. And this is the details given of the partnership firm. We need to do 2 things. First, the firm do not want to get its books of accounts audited, and the firm is asking us to compute total income. So we will try to follow what? 44AD for the firm. But the problem is the turnover of the firm is 2 crore 80 lakhs. Can a firm with a turnover of 2 crore 80 lakh follow 44AD? Yes. If a firm's turnover is more than 2 crore but up to 3 crore, they can also follow 44AD if the cash receipt is up to 5% of the turnover. Now what is the cash receipt of the turnover? 10,50,000 over here, you can see on the board, this is cash receipt. This 2 lakh rupees is also cash receipt. What is the turnover of the firm? The turnover of the firm is 2 crore 80 lakh rupees. Therefore, this cash receipt divided by this turnover will come to less than 5%. Now, because it is coming to less than 5%, therefore, the firm is eligible for 4480. Now, because the firm is eligible for 4480, let's compute the income. Out of 2 crore 80 lakh rupees, 12 lakh 50,000 rupees is cash. Therefore, that will be subject to 8% deemed income, and balance 267 crores, 267 lakh will be subject to 6% deemed income. I hope it is clear to all of you. So this is how I am going to compute the deemed income. 12 lakh 50,000 will be subject to 8% because it is received in cash, and balance is received by online mode. Therefore, that will be 6%. From that, from what this is what 4480 deemed income is all about. Now from this I will compute what? I will reduce my brought forward loss also, because from deemed income you can reduce the business loss. It is allowed to reduce business loss from the deemed income. After that I will compute my capital gains. For capital gains I am selling some plot of land. For how much? Plot of land is sold for 57 lakh rupees. It is assumed that it is sold on or after 23rd July. Therefore indexation will not be available even though it is long term. Okay, the date of transfer is not given in the question. We are assuming it is transferred on or after 23rd July. Now the transfer of plot of land is 57 lakh. What is the cost of acquisition of the plot? The cost of acquisition of the plot is 12 lakh rupees. Therefore 57 minus 12 will come to 45 lakh rupees. This will be subject to 45 lakh rupees will be subject to long term capital gain. Therefore the total income is 61 lakh 30,000 rupees. This is part 1 of the question. Let's go ahead with the part 2 of the question. What does the part 2 of the question says that? Part 2 says that 2 lakh rupees cash which you have received now, instead of that, if it is 4 lakh, then what will happen? Now if this 2 lakh rupees, instead of that 2 lakh, if it is 4 lakh, then my total cash receipts will be 14.5 lakh instead of 12.5 lakhs. So if my total cash receipt is 14.5 lakhs, divide my total turnover is 280 lakhs, it is going to be more than 5%. Now because it is more than 5%, now I cannot follow 4480 because my turnover is more than 2 crore. If your turnover is more than 2 crore and up to 3 crore, and if you want to follow 4480, then your cash receipt has to be within 5%. If it crosses 5%, you cannot follow 4480. Now I have to compute the income as per the P&L account. Now what is the net profit of the SSC? It is 8,65,000. You can see over here. Then they have paid some interest of 15% to the partner. 15% not allowed. Only 12% is allowed. Therefore, 30,000, that is 3%, will be disallowed. I hope it is clear to all of you. Then to all the partners, they are paying a salary. They are paying a remuneration of how much? They are paying a remuneration of 60,000 rupees each to each of the partners. So there are 4 partners. To all of them, they are paying 60,000 rupees per month remuneration. So 60,000 into 12 months into 4 partners. That comes to 28.8 lakhs. So this will also be what? Disallowed. This will not be allowed because this is the actual remuneration which is debited to the P&L. Then they are paying some 12,000 rupees cash to clerk. So if you make a payment of more than 10,000 in cash to a person in a day, that is also disallowed. You can see over here on the board, 12,000 is paid to cash in clerk which is debited to P&L. So that will also be disallowed over here. So I will disallow that also. Then there is some profit on sale of land which is also credited to P&L. So that also I will reduce from here. Ultimately the book profit is coming negative. So if the book profit is negative, then what is your answer? If the book profit is negative, then you get a deduction of maximum 3 lakh rupees. You will get maximum how much? Maximum 3 lakh rupees. So 5,81,000 is my profit, book profit. From that I will get remuneration deduction of 3 lakh rupees, and then 8,81,000 rupees is my what? Is my business loss. I have to reduce my business loss also over here, and then I will get 8,81,000 rupees as my what? As my business loss. Now this business loss I will do what? I will set off this business loss against my capital gains, and I can set off this against my capital gains. Definitely business loss can be set off against what? Capital gains income. That's what I am doing. Therefore the income over here is 36 lakh 19,000 rupees. I hope it is clear to all of you. Let's move on to the next question. The next question is on business trust and its unit holder. There is a business trust by the name called as Beta Limited, and there is a unit holder by the name called as Mr. Arpan. Okay, Mr. Arpan holds 70% of the units of the business trust, and the SPV of the business trust is H Limited. Now we need to compute what? Total income in the hands of business trust as well as total income in the hands of Mr. Arpan according to the income tax law. Let's start with the first one. First, interest from SPV H Limited, 12 crore rupees. Okay, now interest from SPV is exempt in the hands of business trust and it is taxable in the hands of investor. So Mr. Arpan, he will be paying tax on that. On how much amount he will pay tax? He will pay tax on 70% of 12 crore. 70% of 12 crore comes to 8.4 crore. Why 70%? Because Mr. Arpan is holding 70% stake in the business trust. Second, dividend income is always exempt in the hands of business trust. In the hands of investor, it depends upon whether the SPV has followed 115BAA or not. In this question, SPV is opting for 115BAA. Now because the SPV is opting for 115BAA, the investor has to pay tax on that. So on this also 2 crore into 70%, that is 1 crore 40 lakh, investor will pay tax. If SPV would have not opted for 115BAA, then investor would have also been exempt from dividend. Okay, then short-term capital gains on the transfer of property, certain developmental property. Business trust will pay tax at MMR, investor it is exempt. Similarly, interest from unlisted companies debentures, business trust will pay tax at MMR, investor it is exempt. And last but not least, rental from property, business trust it is exempt, for investor it is taxable, and it is taxable, 70% will be taxable. Therefore 1 crore 40 lakh, this also will be taxable. Now, one very important amendment made by Finance Act 2023 last year. Now, how much REIT is distributing to the unit holder? The REIT is distributing to the unit holder 20 crore rupees. So if whatever is distributed over and above, see what I am circling, whatever is distributed over and above what is taxable or what is exempt in the above 5 points, whatever is distributed over and above these 5 things, that will be taxable in the hands of the investor under income from other source. So let's see how much is distributed over and above 20 crore rupees. Over and above, how much is distributed over and above the above 5 points? Let's see. The 20 crore rupees is the total distribution. First 12 crore is distributed, then 2 crore is distributed, then 1.2 crore is distributed, then 12 lakh is distributed, then 2 crore is distributed. The 5 items total is 17.32. Therefore, what is over and above distributed to the unit holder? 2.68 crores. This 2.68 crore is taxable in the hands of the unit holder under 56(2), section 56 subsection 2 clause 13. It is taxable, clause 12, sorry. It is taxable in the hands of the investor under 56 to 12. Now, Mr. Arpan will pay tax on how much? Mr. Arpan will pay tax on 70% of that. 70% of that comes to how much? 70% of that will come to how much? Will come to 37,60,000 rupees. So this is how we are going to compute this particular answer. I hope it is clear to all of you. The next question is a very simple theoretical question. There is a case law. This question is based on a case law of a Supreme Court. ABC is a telecom company. It has entered into an agreement with its distributor to sell its prepaid products. Now, what is the agreement between both of them? Suppose I am a telecom company and you are my distributor. So there is an agreement between both of us that I am selling you some prepaid coupons, etc. for the purpose of recharge of recharge of telephones, mobile phones, and you can sell that at a MRP, and MRP or less than MRP or more than MRP. What you can sell at any price, but I will be giving you at a discount. Suppose I am giving you at a discounted price of 70. Now you can sell at 80, you can sell at 90, you can sell at 100, whatever price you wish to. The difference amount will be yours. Okay. Now the question is, the difference which you are keeping with you, is that a commission for which TDS under 194H will be applicable? The court has said no, this is not a commission. Why? Because as a telecom company, I would not be under knowledge. I would not be knowing that which distributor is selling which coupons to which customer at what price. I don't have the data of that. To some customer you might be selling at 80, to some customer you might be selling at 90, to some customer you might be selling at 110. That is absolutely at your discretion. Therefore, I am not having the knowledge at what price you are selling it. Therefore, I cannot do what? I cannot deduct TDS on that amount on which I am not aware only of the amount on which I am supposed to deduct the TDS. Therefore, TDS is not applicable in this particular case. I hope it is clear to all of you. Let's go ahead with the next question, which is on survey. The assessing officer has surveyed a sports complex at 9:30 p.m. in the night, and the complex is open for business hours every day from 5 a.m. to 10 p.m. Now the assessee is saying that the AO cannot enter after sunset and late in the night. The AO is saying that. Let's see whether the contention of the AO is correct or not. Okay. Further, the AO wanted to take away the books of accounts and cash kept at the premise. Is the action of the assessing officer correct? So there are two things that we need to answer. First of all, can the AO do a survey in the night at 9:30 p.m.? The answer is obviously yes. See, generally under 133A it is very clearly written that the survey can be done after sunrise but before sunset. If the AO wants to enter any business premise, he can enter after sunrise but before sunset. But there is an exception to this rule where the business hours is in night. If the business hours is in night, then the AO can enter in the night also. Obviously, the business hours of this assessee is in the night. The business hours is from 5 a.m. to 5:10 p.m. and the AO is entering exactly during the business hours. Therefore, it is valid. But one more thing, before doing the survey, the AO has to take what? The approval from higher authority like Principal Director General, Principal Commissioner, Principal Chief Commissioner and Chief Commissioner. If he has not taken the approval, then he cannot do the survey. Okay. This is the first thing that we need to answer. Second thing that we need to answer, can he impound books of accounts? Yes, he can impound books of accounts with him, but if he wants to impound the books of accounts for more than 15 days, then he has to take an approval from higher authority. Plus, can he take the cash with him? He cannot take the cash with him. Under section 133A, that is for the purpose of survey, he cannot take the cash with him. That is absolutely not allowed for him to take the cash. He cannot take anything apart from the books of accounts and documents. He cannot take any valuable item with him. I hope it is clear to all of you. Next one, is a small section or a small question on different kinds of penalty that can be imposed on the SSE. First is there is an eligible investment fund covered under section 9A and they have to file some statement. So they have to file the statement within 90 days from the end of the financial year. Now he has filed the statement on what? The trust has filed the statement on 31st of July 2025, which is beyond 90 days from the end of the financial year. 90 days ends on 29th of June and they are filing on 31st of July. Therefore they will be liable for a penalty of 5 lakh rupees under section 271 FAB. Check. They will be liable for a penalty of 5 lakh rupees under section 271 FAB. Next one. Meena Caterers. Meena Caterers is receiving 1 lakh in cash and Meena Caterers is receiving 9 lakh by account pay check. So now, is that fine or will there be any penalty? It is absolutely fine. You can receive below 2 lakh rupees in cash. You cannot receive 2 lakh or more in cash. So Meena Caterers is absolutely correct. They are receiving 1 lakh only in cash and 9 lakh is received by account pay check. Therefore, no penalty can be imposed on Meena Caterers. Third one. The premises of a company TIP Limited was searched and undisclosed income of 18 crore was determined. The company did not admit the undisclosed income. Company did not admit the undisclosed income under section 132 statement. If they would have admitted that, then the penalty would have been only 30% of undisclosed income under section 271 AAB. But because they have not admitted the undisclosed income under 132 subsection 4, therefore the penalty over here will be 60% of undisclosed income under section 271 AAB. But fortunately, this penalty is not much relevant from 1st of September 2024. That is from the date on which the new search and seizure block assessment has been introduced. I hope it is clear to all of you. Now, the next question is one of the most beautiful question on DTAA. Believe me, if you do only this question on DTAA, that is much more than sufficient for your exam. Let us read. This one question covers every kind of aspects of DTAA. This is a resident. Mr. Ram Prakash is a resident. His age is 58 years and he's earning income from India and two more countries, country X and Y. India does not have DTAA with country X and Y. Therefore, you need to find out the unilateral relief. Now, first of all, we need to compute the income in India. While computing the income in India, we will take everything. First of all, gross rental. So 2,50,000 plus 2,50,000, 5 lakh is the gross rental. From that, he will take 30% standard deduction. Then loss from country X and Y, you can set off against the business from India and business from country X and Y. So you can take the total of these three business, 2,80,000, 3,40,000, 1,80,000, minus 1,20,000, minus 1,30,000, you can set off that loss in India. Okay, that is all allowed. Then STCG, you can take under income from capital gain. Then 37 lakh is long-term capital gain on sale of residential property in India. And then you are purchasing another residential property in India in the name of your wife. In the name of wife, it is allowed. It is allowed. So you are selling one property, you are purchasing another property. Therefore, that will also be exempt under section 54. Therefore, the net long-term capital gains will be only 12 lakh rupees. Then agriculture income in country X is taxable, country Y is taxable, country X is country India. India's agriculture income is exempt. Okay. Now, PPF not allowed as deduction because the SSE is following. If you see the last line, 115 BAC, that is one new regime. If you are following new regime, then PPF will not be allowed as what? Will not be allowed as deduction under 80C. I hope it is clear to all of you. After doing all these things, you will get your total income as 37 lakh rupees. Now you will compute tax. Now be very careful. While computing the tax, don't compute tax on 37 lakh. You have to compute tax as per the partial integration scheme because the SSE is earning some exempt agriculture income in India. Therefore, you have to compute tax on 37 lakh plus 5.2 lakh first. So first you will compute tax on agriculture income plus your total income. So you will compute tax on 42.2 lakhs first. How will you compute tax on 42.2 lakhs? On 12 lakhs long-term capital gains, flat 12.5% tax, and on balance you will apply the slab rates. Okay. Then step number 2, you will compute tax on agriculture income plus basic exemption limit. What you will compute? You will compute tax on agriculture income plus basic exemption limit. Then you will take the difference between the two. Difference between step 1 and step 2. That will become your final tax. On that you will apply cess, and then that will be your final tax liability in India. From that you will get some relief after some time. Now let's find out the average rate in India. The average rate in India will be 7,42,560 is the tax in India and the income in India is 37 lakhs. So therefore the average rate in India is 20.07%. Now one problem is there in this question. This problem has never ever arisen in any question apart from this question. That is, in country Y you have a flat rate of 27%, but in country X we don't know the average rate. In country X they have given us the slab rates. So for country X we need to find out the average rate first. Without knowing the average rate of country X, I cannot compute the doubly tax income. I cannot compute the relief. Therefore let's start with the average rate of country X. In country X, what is the first income that you are earning? You are earning a rental of 2,50,000 rupees. So on that, will you get any deduction? No deductions are allowed in country X or in country Y against the house property income. Whether this loss is allowed in country X, This loss is not allowed in country X. You can check it over here. Therefore, I cannot set off this loss in country X. Now I am computing the total income of country X, and then I will apply the slab rates of country X, and then I will find out the average rate of country X first. Similarly, this business income you will take in country X, this short-term capital gains you will take in country X, and this agriculture income is exempt in country X. As you can see over here, in country X, agriculture income is exempt. Therefore, that will not be subject to tax. So in country X, only three incomes are there. Rental property without any deduction of house property expenses, then 2,80,000 business income, and STCG from sale of vacant land. So 16,10,000 is the total income of country X. This is computed as per country X. So now I will apply the slab rates of country X. Up to 3 lakhs no tax, above 3 lakhs 15%, above 6 lakhs 22%. That will give me 2,67,000. So therefore now I will get the average rate of country X. The way we already have the average rate of country Y, which is 27%. For country X we have computed to be 16.596%. This is the average rate of country X. Okay, now after that it's a normal question. For country X you will find the doubly tax income, then this rate or average rate in India, whichever is lower, that will be the relief. For country Y also, the average rate in India or the average rate in country Y, which is 27%, whichever is lower, that will apply that you will apply on the doubly tax income, that will be exempt under the income tax law. I hope it is clear to all of you. Let's go ahead with the next question. Question number 8. There is a company by the name called as a Peter Inc. company, which is incorporated in United States. Now the global assets of the company is 50 crore. The Indian assets are 25 crore. The turnover of the company is 90 crore. Now because of this, the company is failing the ABOI test. Why? Because the Indian assets are exactly 50% of the global assets. The Indian assets have to be less than 50% of the total assets. If the Indian assets are exactly 50% of the total assets, you are violating the conditions of ABOI test, and therefore you become resident in India. Apart from that, there is one more reason why you are resident in India. That is, out of 10 board meetings, 4 board meetings are held in India. The key management and commercial decisions are mainly taken in India only. Therefore, this company is what? This company is a resident company. At the same time, this company is also a foreign company. Now the question is, if a foreign company becomes resident in India because of POEM, because the place of effective management of this company is India. So if a foreign company becomes resident in India because of a POEM, so if I make a payment of professional fees to this company, whether I will deduct TDS as per 194J or I will deduct TDS as per 195. So on that day, there is a CBDT notification which was issued in 2018, which says that if the foreign company is a resident as well as a foreign company, then you have to deduct TDS as if it is a foreign company. Therefore, you have to consider 195 and not 194J. You have to deduct TDS as per section 195 and not as per 194J. And one last question in this RTP is, B Limited is an Indian company located in SEZ in which TQR Inc. a company holding 30% stake. Therefore, B Limited and TQR are deemed to be associate enterprise because the holding period is 30%. Now, B Limited sold 90,000 goods at rupees 10 to TQR, whereas to others it is selling at 12 per unit. So to associate enterprise you are selling at lesser price, to outsiders you are selling at more price. Therefore the differential amount has to be added back to the arm's length price. So therefore $2 per unit into 90,000 pieces into 85 rupees per dollar, that will be added back to the arm's length price. Similarly, to associate enterprise, you are paying 15,000 guarantee fee. To outsiders, you are paying only 12,000 guarantee fee. Therefore, $3,000 has to be added back. $3,000 into 85, that will be added back over here. Similarly, to associate enterprise, you are paying some amount of $18,000. To outsiders, you are paying some amount of $16,000. Therefore, this $2,000 will also be added back into 85 rupees. This will also be added back over here. And therefore, whatever income is added back over here, that will increase your arm's length price. Now, the last question over here is, if this amount is increased by assessing officer, can I claim deduction under 10AA on this increased amount? And the answer is no. As per the proviso to 92C subsection 4, first proviso to 92C subsection 4, if an arm's length price is increased by assessing officer, then on that increased arm's length price, you cannot claim deduction under 10AA or chapter 6A. I hope it is clear to all of you. So let us go ahead with our last RTP, that is RTP May 2025. After that, we will be done with 9 RTPs, including the latest one, that is May 2025 RTP. Now, the very first question over here is question number 14. Before that, there are 13 questions which are your MCQ case scenarios of May 2025. If time permits, I am not making any commitment. If time permits, I will discuss those MCQs also later on. But right now, my objective is to discuss the descriptive questions with you all. Now, the very first question over here is on total income question. Let's see what exactly they want in this particular question. If you read the last line, they are asking total income and tax liability of a company as per 115BAA. So we need to solve this question as per 115BAA. Let us start the question now. The very first thing is the assessee is a private company. It is a domestic company. It is engaged in manufacturing and the profit of the company is 1 crore 7 lakh rupees. Now, what is credited to P&L? The first item which is credited to P&L is rent from a vacant land. Now, rent from a vacant land is considered to be an income from other source. Okay. So you have to reduce from here and you have to show under what? Income from other source. Now, next one, rent received from a commercial property, 5,30,000 rupees. Now, this rent which is from a commercial property, this is an income from house property. You have to reduce from PGBP and you have to show under income from house property. And in income from house property, you will take 30% standard deduction. So in 115BAA, we get standard deduction. The answer is yes. In 115BAA, you will get the standard deduction, but in 115BAB, you do not get the standard deduction of house property. Be very careful. Next one is interest on income tax refund. Reduce from here, show us in the income from other source. Next one is profit on sale of plot, 8 lakh rupees. Now the profit is 8 lakh rupees on sale of plot. So this will go under capital gain. So reduce from here and find out the capital gains of this particular asset. Now, what is the capital gains of this particular asset? The capital gains will be as follows. Pay attention, please, all of you. Now, if you see over here, the plot was purchased for 50 lakhs in 23 Jan and it is sold in March 25 for 58 lakh rupees. Therefore, it is a long-term capital gains. And now, because it is a long-term capital gains, LTCG of 8 lakhs will be subject to tax at 12.5% because it is sold on or after 23rd July. Okay. Indexation will not be available from 23rd July to domestic companies. So therefore, 8 lakh rupees will go under long-term capital gains. 12.5% will be the tax rate. Then dividend of 6 lakh rupees you have received from what? A foreign company. So this will be reduced from here and it will go to income from other source. Now to earn this dividend, you have raised some loan from a bank. Now on that you have paid an interest of 1,50,000 rupees. So can I get the deduction of this interest against my dividend income? Yes, you can get the deduction of interest against dividend income only to the extent of 20% of the dividend. Therefore, the dividend is 6 lakhs. Now in IFOS, I will get 20% deduction. Therefore, I will get a deduction of 1.2 lakh rupees in IFOS. I hope it is clear to all of you. Now, what is the statement? What is debited to the statement of P&L? Now, we have to add back this depreciation chart to the statement of P&L because that is accounts depreciation. Donation to Swachh Bharat Abhiyan, it is not allowed under 115BAA. It is not allowed under chapter 6A also in 115BAA. So therefore, this will be added back. Then actual contribution to pension scheme. Now, how much contribution to pension scheme is allowed to employer? Only 14% is allowed from Finance Act 2024. Earlier, it was 10% of basic salary plus DA in terms. Now it is up to 14%. Now, what is the salary in this question? If you see this question properly, it is written over here. The salary for the purpose of 80CCD, the salary that is salary and dearness allowance is 10 lakh rupees. So 14% of that will amount to 1,40,000 will be allowed. But only 1,40,000 will be allowed. But you are paying how much? You are contributing 1,90,000. Therefore, 50,000 will be disallowed over here. I hope it is clear to all of you. Next one, you are making a payment of 68,000 to a transporter. By how? By account pay check. No TDS has been deducted. You have not deducted any TDS of that transporter. The transporter has furnished PAN to you. The transporter has also given a declaration that he is coming under 44AE. Therefore, it means that the transporter does not own more than 10 goods carriage at any time during the previous year. If all these conditions are fulfilled, then there is no need to deduct TDS under section 194C. 194C, there is a relaxation for you when the transporter does not own more than 10 goods carriage and he gives a declaration and PAN that he does not own more than 10 goods carriage. Therefore, there is no need to deduct TDS. Okay. Next, bonus to employees is allowed on a payment basis, not on accrual basis. You have to make the payment as per 43B till the due date of filing of return. You are making the payment on 18 December 2025, which is beyond due date of filing of return. Therefore, this will not be allowed as deduction. I hope it is clear to all of you. Next one, income tax disallowed. Interest on income tax is also disallowed. Next one, donation to Scientific Research Association, not allowed under 115BAA, therefore add back. And the last one, which we have already done along with the dividend income. Next one is you have some income tax depreciation of 18 lakh rupees. So take that 18 lakh rupees as deduction. But in that you have made some mistake. Let's see whether you have made a mistake or not. You have considered printer and scanner as computer. So are printer and scanner considered to be a computer? The answer is yes. That is absolutely correct. Computer and its accessories and its peripherals are considered to be same as computer. Therefore, this 40% you have correctly classified. But is EPBX also considered to be computer? The answer is no. EPBX cannot be called as computer. It is called as telephone. Therefore, it is subject to 15% depreciation. So here you have made a mistake. Mistake of how much? You have claimed 40%. You should have claimed only 15%. Therefore, 25% of the depreciation I have to add back. What is 25% of 5 lakh rupees? 25% of 5 lakh rupees comes to 1,25,000 rupees. That much I have to add it back over here. Then additional depreciation will not be allowed under 115BAA. So forget about it. Then last year provision for audit fee. Last year you have made a provision for audit fee of 1 lakh rupees, but you have not deducted the TDS in the last year. Therefore, 30% of last year would have been disallowed in the last year. Therefore, in the current year, you have paid the TDS, you have paid the tax also. You have deducted the TDS, you have paid the TDS in the current year. Therefore, in the current year, you will be getting the deduction of that particular TDS which you have paid in the current year. Therefore, 30,000 will be allowed as deduction in the current year. Similarly, last year, you have provided a books of accounts, a bill of 90,000 rupees for purchase of raw material. So 90,000 rupees you have taken deduction in the last year on an accrual basis. But in the current year, you are making 45,000 rupees payment in cash on 20th August. That is not allowed. That will be considered to be deemed income under section 40A3A. If you make a provision of an expense in 1 year and make the payment of that expense in cash in the next year in excess of 10,000 rupees to a person in a day, then in the next year it is considered to be a deemed income. Next is you are issuing shares. You are a closely held company. Be very careful. The SSC is a private company. It's a closely held company, and it is issuing shares at a price lower than at a price higher than the FMV. The FMV of the share is 60 rupees, and you are selling the shares as 100 rupees. So earlier in such cases, income from other source was applicable in the hands of company under section 56(2) clause 7B. But from Finance Act 2024, with effect from 1st April 2024, this section has been discontinued. Therefore, nothing has to be done for this particular section. I hope it is clear to all of you. Now, next one is done. And the last one is you have declared an interim dividend of 5,20,000 in September 2024. So you will get deduction under ATM of this 4.8 lakh rupees. 4.8 lakh rupees. Why, sir? Because the declaration is 5.2 lakhs, but the earning of dividend is only 4.2 lakhs. You can check it over here. What is the dividend earned? That is 6 lakhs minus 1.2 lakhs. Only 4.8 lakhs is the dividend income. Income is 4.8 and distribution is 5.2. Therefore, it will be restricted to 4.8 only. Then you will compute the tax on long-term capital gains. You will 12.5%, and on other income you will compute tax at 22% plus surcharge of 10% and cess of 4%. I hope it is clear to all of you. Now let's move on to the next question. That is the question on charitable trust. There is a trust registered under 12AB which derives income of 500 lakhs during the financial year. Now the trust wants to give donation of what? 200 lakhs to another trust, ABC Educational Trust. Regarding this, we need to answer a few questions. So the trust wants to give donation of 200 lakhs. Regarding this, we need to answer a few questions. Very first question. How much amount paid by the trust will be considered as an application? First, if this is given as a general donation, not as a corpus. So if you give a donation as a general donation, then it is allowed as a deduction. If you give donation as a corpus donation, then it is not allowed as a deduction. Therefore, if you give the donation as a general deduction, 85% of that will be allowed as deduction. So 85% of 200 lakhs will be allowed as deduction. Second part, if you give that as a corpus donation, then it is not allowed as a deduction, because we all know that if you give a donation as a corpus donation, then it is not allowed as a deduction to the charitable trust. Now second part, part B. Would your answer change? If it is paid out of the accumulation of XYZ Limited, then nothing will be allowed. You have to give donation from the current year income. If you give donation from the accumulation of the last year's, then it is not allowed. Then even in the first case, it will not be allowed. In second case, anyways, it is never allowed. For corpus donation, it is never allowed. But if you give out of accumulation, then even general donation will not be allowed to the SSC. Apart from that, 30% tax will be imposed on the SSC under section 115 BBI for violating the provisions of the income tax law. So 30% income tax will also be imposed on the SSC. I hope it is clear to all of you. Next, also examine the conditions with which ABC requires to satisfy for not including the amount received from XYZ with a specific directions for forming part of the corpus trust. So see, if you are receiving any corpus donation, then what all conditions you have to fulfill if you want to make that corpus donation exempt. See, once you receive, there are 3 steps over here. Once you receive the corpus donation, it will become exempt only if you invest that corpus donation in the mode specified in 11.5. For example, I received 100 crore today. So if I want to exempt 100 crore, I have to invest in the mode specified in 11.5. This is the first thing. Once I invest in the mode specified in the 11.5, it is exempt. Second step, once I withdraw that money later on and purchase and use for the purpose of corpus, I have to withdraw that money now from the 11.5 modes and I have to use it for the purpose of corpus. At that point of time, it will not be allowed as application. Third step, when you deposit back that particular amount in the corpus, when you deposit back that amount in the 11.5 mode within 5 years, if you deposit back in the 11.5 mode, then it is allowed as an application. And if you violate any of the conditions over here, it will be subject to tax. And here also provisions of 115 BBI are applicable and you will be subject to 30% flat tax. I hope it is clear to all of you. Next question. Next question is Mr. Amit is an Indian resident. He has purchased some virtual digital assets like cryptocurrencies and NFT. Now let us try to see what he has purchased and what he has sold and how much tax will be imposed on him. First of all, he has purchased one Bitcoin of 60 lakh rupees and his friend has given him one NFT of 5 lakh rupees. His friend has given him as a birthday gift 5 lakh rupees NFT, and then he has bought one NFT for then he has bought one NFT for 10 lakh rupees. His friend has brought this NFT for 4.5 lakh rupees. Now due to financial need, he is selling one by one. I will try to compute. He is selling half Bitcoin. So half Bitcoin if he is selling, and expense on transfer is 0.1%. So how much capital gains will be imposed on this? See, he is selling half Bitcoin for 28 lakhs. Therefore, sale consideration is 28 lakhs. Now, what is the value of full Bitcoin? The value of full Bitcoin is 60 lakhs. So, what will be the value of half Bitcoin? It will be 30 lakhs. Therefore, 28 lakhs minus 30 lakhs will be 2 lakh loss. So, I will not get the deduction of expense on transfer. No. In case of transfer of virtual digital asset, you don't get the deduction of any expense except cost of acquisition. Cost of acquisition is the only expense which will be allowed. Apart from that, no other expense will be allowed. Even expense on transfer will not be allowed. Now, sir, here 2 lakh rupees loss is coming. What has to be done with this? This will be lapsed. This cannot be set off against any income. This cannot be set off against other gain of virtual digital assets also. Again, I am saying this cannot be set off against other gains of virtual digital asset also. This is completely scrapped. This is completely lapsed. Okay. Now, this is the first thing. Second, income. He has got a gift from his friend of 5 lakh rupees. You can check over here. So, therefore, that gift will also be what? That gift will also be what? That gift will also be subject to what? Income. That gift will also be subject to income tax. Further, he has received other income of 6.5 lakh. So, that will also be other income. And last but not least, what will be his income? Last income will be the NFT which he has received from his friend. He is selling that NFT for how much? He is selling that NFT for around 6.5 lakh rupees. Okay. So for 6.5 lakhs, he is selling that NFT. Therefore, I have to compute capital gains for that NFT also. Now, which NFT he is selling? He is selling that NFT which he is received from his friend as gift. So, he is selling for 6.5 lakhs. What will be the cost of acquisition? The cost of acquisition will be the FMV which we have taken earlier under income from other source. Okay. Because on 5 lakh rupees, you have already paid tax under income from other source, as you can see over here. Therefore, this will become your cost of acquisition. Therefore, 1.5 lakhs will be your capital gains. That will be subject to flat 30% tax. Okay. Now, I'll tell you, this 2 lakh rupees loss is lapsed. This 1.5 lakh rupees is subject to flat 30% tax. And this 5 lakhs and this 6.5 lakhs will be subject to what? Slab rates. Okay. Now, the question is asking us to compute tax payable. Whenever I have told you earlier also, whenever they are asking tax payable, we need to also compute the TDS and TCS which has been deducted in our case. Now, when somebody has, pay attention please all of you, when somebody has purchased Bitcoin and NFT from us, they would have deducted our TDS. Yes or no? Under 194S. So, we are selling Bitcoin of how much? 28 lakhs. So, the buyer would have deducted TDS of 1%. We are selling NFT of how much? 6.5 lakhs. So, the buyer would have deducted our TDS. So, that credit we will get. Therefore, this 1% and this 1% will be reduced from your total tax liability, and only then you will get what? Only then you will get your tax payable under the income tax law. I hope it is clear to all of you. Now, let's go ahead with the next question. Question number 18. There is a person, Mr. Vivek, who is a non-resident partner in a partnership firm, Messrs. Pal and Company. So, Messrs. Pal and Company, it is a partnership firm in India in which Mr. Vivek is a partner, and he has contributed 50 lakh in the firm, and the firm is paying him 10% capital, interest on capital, and the firm is also paying him profit share every year. Okay. So, there is a Indian firm in which there is a foreign partner. The Indian firm is paying him share of profit. The Indian firm is paying him interest on capital. Okay. Apart from that, there is also Mr. Vivek's friend. His name is Vikas. Mr. Vivek's friend Vikas is also a non-resident, and Mr. Vikas is providing the firm fees for technical services for projects in India. Okay. So, Mr. Vikas is paying some fees for technical services for projects in India of 5 lakh rupees. Now, both Mr. Vivek and Mr. Vikas are resident of country X. Now, there are multiple questions over here. As a tax consultant, first we need to advise, is the firm liable to deduct TDS on interest on capital and share of profit first? Then, is the firm liable to deduct TDS on FTS? These are the two questions that we need to answer. Assuming that India has no DTAA with country X, in case tax is not deductible, is there any other related requirement? So, I'll be telling you one by one for everything. First of all, the firm is paying interest on capital to the partner. So, TDS under 194A is not applicable. Why? Because 194A is only applicable to resident partners. It is not applicable to non-resident partners. But the interest which is paid to non-resident partners, the TDS will be applicable under section 195. Under section 195, the TDS has to be deducted, and the TDS has to be deducted at the rates in force, and the rates in force is 30%. Okay. So, for interest on capital, the firm has to deduct TDS at the rate of 30%. Now, for share of profit, there is no need to deduct any TDS. There is no need to deduct any TDS for share of profit. Why? Because the share of profit is exempt in the hands of the partner. Therefore, there is no question of deducting TDS. But yes, there is a related requirement which is asked over here. The firm has to fill what? Form 15CA and 15CB. Form 15C and 15CB is mandatory irrespective of whether the income is chargeable to tax or not. You have to fulfill this certain procedural requirements under the income tax law. Now, the third thing, you are also paying Mr. Vikas some fees for technical services. So whether this fees for technical services is accrued in India, the answer is yes, because it is related to project in India. Therefore, it is accrued in India, it is taxable in India. Now the question is whether TDS will be deducted. The answer is yes. Now the question is, it is taxable under which section? It is not taxable under 115A, because again there is no agreement between both of them which is approved by central government. 115A is only applicable only if there is an agreement between two parties which is approved by central government. Therefore, this is not covered under 115A. I hope it is clear to all of you. So this will go under the general provision, but it is taxable, it is accrued in India. Therefore, TDS will be deducted at 30%, which is the normal rate for a non-resident. So 30% TDS will be deducted in this case. Okay. Now, there is part 2 over here. If India has a DTAA with country X, suppose India has a DTAA with country X, and the DTAA says that 10% is the tax in case of FTS. How much we are deducting? We are deducting 30%. But if the DTAA says that 10% is the tax, what is the remedy available to Mr. in case of Mrs. Pal? India has deducted TDS at the requisite rate provided under the Income Tax Act. So now listen carefully. How much TDS we have deducted? 30%. If DTAA says that it is only 10%, then what is the remedy? See, if the TDS is borne by the payer, that is if the TDS is borne by Mrs. Pal and Company, that is the firm, then there is a provision of section 239A which is applicable in this case. So what is 239A? 239A says that if the payer has borne the TDS and if the payer has paid extra TDS, in this case the payer should have deducted TDS at 10%, but the payer has deducted mistakenly at 30%. So whatever extra TDS, if payer has borne the TDS, then the payer can make an application as per 239A to the assessing officer within 30 days, and the AO will give him the refund of that particular extra 20%. But that is only possible if payer has borne the TDS. If payee has borne the TDS, it means if Mr. Vikas has borne the TDS, it means the non-resident has borne the TDS, then the relevant person who should get that particular TDS is the Mr. Vikas only. Then Mr. Vikas deserves to get that TDS in his bank account. I hope it is clear to all of you. Now, coming to the next question, which is a very simple question but a beautiful question. Mr. Bhuvan is a purchaser. Be very careful. What is Bhuvan doing? Bhuvan is purchasing certain raw material, and Srinivas is what? Selling certain raw material. Now, how much raw material you have purchased? You have purchased 3,20,000 rupees raw material through cash. Now, that is a mistake you have done. So, if the buyer is purchasing goods of, if the buyer is making a payment of more than 10,000 rupees other than account pay, check, account pay, draft, ECS and such other electronic mode, then in the hands of buyer, this will be disallowed under 40A3. Similarly, for seller also, 3,20,000 is the invoice made on 27th of March. So, if the transaction is of 2 lakh rupees or more on a particular day. So is the transaction of 2 lakh rupees or more? The answer is yes, on 27th of March. Then the seller cannot receive even single rupee in cash. Now the seller is receiving 3,20,000 in cash. Therefore 269 ST will be applicable for seller, and the penalty under 271 DA will be applicable in the hands of seller of 3,20,000 rupees. Now the second part of this question is, will there be any detriment? Second part, what will your answer be different if the cash purchase are effected by Bhuvan on 2 different dates? So if this 3,20,000 is not on 27th March, say it is on 27th and 28th, 1,80,000, 1,40,000, then what will happen? Even then in case of Bhuvan, 40A3 will apply, because the limit in 40A3 is very small limit of 10,000 rupees. In excess of 10,000 rupees, if you pay in a day, then it is disallowed. But yes, in case of seller, now the provision of 269 ST will not apply, because you are doing 2 different transactions of less than 2 lakh rupees on 2 different dates, and therefore now you can receive cash amount of 1,80,000 and 1,40,000, because you are not doing on one single day, you are doing on 2 different days. I hope it is clear to all of you. Let's move on to the next question, which is a beautiful question on DTAA. Mrs. Sudha, age 61 years. Let's read the last question, what they exactly want from us. They want a total income of Sudha, net tax liability of Sudha after taking account the FTC. And Sudha is opting out of default regime. It means Sudha is following the old regime. So according to old regime, you have to solve this question. Let's read the question now. Sudha is 61 years, so she is a resident, she stays in Calcutta. She is resident as well as senior citizen. Now she performs in India some classical dance and country M also. So first, normal computation you will do. You will include everything, every income in India. You will compute total income in India. You will compute tax in India, and you will compute average tax rate in India. Let's do that first. First of all, Sudha is earning some 10 lakh rupees from concerts in India. So that will go to the income from PGBP. Then she is earning some country M. From country M, she is earning some income of $12,245. So I have to convert that into rupees as per rule 115. So for this, what rate I will take? I will take the rate on 31st March 2025 as the conversion rate. So what is the conversion rate of country M? Country M dollar on 31st March 2025 is 80 rupees. So I will convert as per 80 rupees this particular amount. Okay. Now the TDS of 2500 is deducted. That will be helpful later on while taking the FTC. Now similarly, she is also earning 10,000 rupees, $10,000 from country N. So now I have to convert that also into rupees. So for that also I have to take the rate on 31st March 2025. So 10,000 into country N, 31st March rate is 79 rupees. So I will take that also over here. Apart from that, she is earning income of interest from bank FD of 4 lakh rupees. Therefore, this will be subject to 80 TTB. 80 TTB, 50,000 standard deduction you will get from this, and 25,000 rupees from saving bank account you are earning. This will be your total income, gross total income. From that, now you will claim what? 50,000 rupees medical insurance for yourself and your for husband, because you are a resident senior citizen. Therefore, you are eligible for a higher limit of 50,000 rupees. So you will get total of 50,000 rupees deduction under 80D because you are resident senior citizen. And last but not least, you will get 80C deduction of PPF 1.5 lakhs, and you are also purchasing 5-year fixed deposit in the name of son, but that is not allowed. Fixed deposit of 5 years is allowed only if you purchase in your name. Only it is allowed. Otherwise, if you purchase in the name of your son, then that is not allowed. So this 3 years, this 3 lakh rupees will not be allowed as deduction. So after that, you will compute your tax. You will compute your tax. There is no special income in this. You will compute tax as per old regime, not as per new regime. Then whatever is the tax divided by total income, you will get Indian average rate. And therefore, the Indian average rate is coming to 24.489%. You can check in what? You can check in the solution given by the ICAI. Now, we need to compute the FTC. Now, for FTC, we are earning income from two countries. One, we are earning income from country N. Another, we are earning income from country M. With country N, we have a DTAA. With country M, we don't have a DTAA. So accordingly, we need to answer. Okay. Accordingly, we need to answer. With country M, we don't have DTAA. With country N, we have DTAA. So let's talk about one by one both the countries. Let's talk about the relief from country M first. In country M, how much tax you have paid? You have paid tax of $2,500 in country M. Okay. Now I have to convert that into rupees. As per the rule 28 of FTC, rule 28 says that you have to convert that into rupees as per what? As per last day of the TTBR of the last month in which the tax was paid. The tax was paid in October 2024. And what is the last day of the previous month? Last day of the previous month will be 30th September. So I have to convert this 2,500 CMD into as per 30th September rate. So this is which country? For country M, check on the board. 30th September rate is 80 rupees. So I have to convert this as into 80 rupees. Okay. Now let's compute the what? Let's compute the FTC of country M. For country M, I have to compute two FTC, whichever is lower will be allowed. The average rate as per India or tax paid in foreign country, whichever is lower will be allowed. Now, this is the doubly taxed income. You can check on the board. Okay, you can check in the calculation given by the ICI. Multiply by Indian average rate. Indian average rate is 24.489%, which I have told you earlier only. Compare with what? The tax paid in the foreign country. Tax paid in foreign country is $2,500 into 80 rupees as per rule 128, which I have shown you. Whichever is lower will be allowed as FTC to you. Similarly, for country N also you have to do the same thing. This is the Indian average rate 24.489 into doubly tax income 7,90,000. And what is the tax paid in country N? In country N, you have earned income of $10,000, out of which 10% you have paid as a tax. Therefore, $1,000 you have paid as a tax. When you have paid? On 25th of March. Again, to convert that, you have to take the TTBR of the preceding month last day. What is the preceding month last day for country N? For country N, preceding month last day is 28th Feb, and on 28th Feb, the rate was 78 rupees. And therefore, as per 78 rupees, 78 into 1,000, that will be 78,000. Whichever is lower will be allowed as FTC. After that, you will get your tax liability. I hope it is clear to all of you. So this is what this beautiful question is all about. Let's go ahead with the next question. Question number 21. Mr. Manan, who remained in country X, returned to India permanently in the last year on 1st February 2024. So he was in country X. He came to India last year in 2024. So in the current year, he is staying in India for how many days? For all 365 days. Therefore, he is resident. Is he ordinary? He is not ordinary because he came last year only to India. It is not possible for him to become ordinary resident, because to become an ordinary resident, he should be resident in at least 2 years out of last 10 years, and he should be in India for 730 days. That is not possible for him. Therefore, he is resident, but he is not an ordinary resident. He is a not ordinary resident. Now, for resident and ordinary resident, which incomes are taxable? Only incomes which are accrued in India or and only incomes which are received in India. Therefore, incomes which are accrued in India, received in India are taxable, and one more income is taxable for R and NOR, and that income is business income which is accrued outside India, but business is controlled from India or profession is set up in India. Those incomes are also taxable. Apart from that, all other incomes are not taxable. Therefore, he is earning some rental income from country X, that will not be taxable over here because he is earning in country X and it is received also in country X. Therefore, house property income will not be taxable in India. Apart from that, he is earning some business income from India. Yes, business income from India will be taxable in India, definitely. And apart from that, he has transferred some land in Indore. Now, when he has purchased that land, he has purchased that land in 18th of May 2022. Now, this part is the most important part of the question. And he has sold on 23rd December 2024, Mr. Sarthak, for 80 lakh rupees. Now, he has purchased the land for how much? 30 lakh rupees. He is selling the land for how much? 80 lakh rupees. Now, he is selling after how many months? He is selling after 24 months. Therefore, the long-term capital gains will be 50 lakh rupees. Now, he has two options. Either he can take indexation or he may not take indexation. Why, sir? Because the asset, because Mr. Sarthak is a resident. Is his name Manan? Sorry, not Sarthak, Manan. His name is Manan. Manan is a resident. Second, Manan has purchased immobile property, land and building before 23rd July. Manan is selling immobile property after 23rd July. And Manan is selling a property which is a long-term capital asset. Therefore, he has two options. He can take with indexation, without indexation. If he takes indexation, then he has to pay 20% tax. If he do not take indexation, then he has to pay 12.5% tax. So remember, all these RTPs which they have made now, latest RTP, all the latest RTP questions are based on generally the latest amendments made by the Finance Act 2024. So in this case, on this 50 lakh rupees, if you take indexation, then obviously the gain will reduce. If you do not take indexation, then the gain will be 12.5 lakhs. According to that, the total income will also change. But this business income will remain same, 12 lakh 50. So on long-term capital gains, you see whether whichever is more beneficial, you have to go for that. But on business income, you will be applying what? The slab rates only. I hope it is clear to all of you. Now, all these exchange rates are of no use. This indexation will be useful to you to claim the indexation in respect of what? Long-term capital gains. I hope it is clear to all of you. Then you compute the tax liability of Manan. This is a very, very simple question, but it was based on amendment. Now, one last question, question number 22 over here, that will complete all our 9 RTP compilation in full English. Now, Triveni Cement Limited is an Indian company. Its head office is at Chennai. Now, which furnish the following information of certain entities and the transaction undertaken with these entities. First of all, there is a company Drift Inc. which is in Japan, which is wholly owned foreign subsidiary of the Indian company TCL. Therefore, both of them are deemed to be associated. So, if one entity is a wholly owned subsidiary of another, then both of them are deemed to be associated. Now, it is currently paying $3 million to TCL. So, Drift is paying how much $1 million to TCL? 3 million. So, to us, they are paying 3 million royalty. But to others, they are paying 4 million royalty. So, to associate enterprise, they are paying less royalty. To others, they are paying more royalty. Therefore, the differential amount has to be added back. 1 million is nothing but 10 lakh dollars. Okay. So, 10 lakh dollars into 82 will come to 820 lakhs. This much will be added back to the income of the assessee. Now, the second question. There is another entity, Swift Dubai, and there is another entity, Indian company TCL. Okay. Now, TCL has borrowed a loan of 220 crore from Swift. And the book value of the assets of the TCL, you can check over here, is 330 lakhs. So how much loan we have taken? 220 crore. And what is the book value of our asset? It is 330 crores. So how much Swift is financing us? Swift is financing us 66.67%. Now, if one enterprise finances another enterprise, at least 51% of the book value of the assets, then both of them are deemed to be associated. Therefore, Taylor and Swift are deemed to be associated. Now, very important point. How much interest we are paying to Swift? We are paying interest of 17.6 crore to Swift, which is 8%. How much interest we are paying to others? We are paying to others only how much? Only 7%. Okay. So only 7% we are paying. So to our associate enterprise, we are paying interest of 17.6 crore. That is 8%. To others, we are paying 7%. Therefore, 7% will amount to how much? It will amount to only 15.4 crore. So 15.4 crore is the correct arm's length price. But we are paying how much? 17.6 crore. Therefore, excess 2.2 crore has to be added back. So this will be added back to the income statement. I hope it is clear to all of you. And the third one, TCL supply goods to Truewords. So TCL supply goods to Truewords Limited. Now, the paid up capital of Truewords is 92 crores and our stake is 22 crore. So, if the other company's total paid up capital is 92 crore and our stake is 22 crore. Therefore, that amounts to how much percentage? 23.91%. So, that is less than 26%. Therefore, it is not possible that both of them are deemed to be associate enterprise. They are not associate enterprise. Therefore, transfer pricing provisions are not applicable in this case. I hope it is clear to all of you. So, this is what this compilation is all about. So finally, I have made my commitment. I have made a commitment that I will be uploading in the second week of the April, but I tried my best to upload on the first week of the April itself. That too on the 1st of April 2025. That is on the very first day of the new financial year. I hope you all have enjoyed this video in full English. It takes a lot of pain. Again and again, I am saying it's not that easy to speak all the things in two languages again and again. So it is my sincere request to all of you, that much I can ask from you all, that if you have liked this video, I want you all to share this video at least with 50%. One person will share with at least 50 people. And I want second request from you all. I want you all to comment below that what is your experience regarding learning direct tax and especially this video from me. And the third thing, when do you want me to upload the past paper compilation and the MTP compilation also? Till then, take care all of you. Have a nice day and enjoy this video to the extent it is possible.